We would like to extend a warm welcome to all the faculty members, alumni, students, and our audience joining us live on YouTube. Madhusudan Kela founded Investrix in 1991, which was organized as a panel discussion event. It has been a flagship initiative of Somaiya Institute of Management for over 3 decades, serving as a platform for meaningful dialogue and valuable insights from industry leaders. To mark the beginning of Investrix 2026, we invite Dr. Raman Ramachandran, Director of Somaiya Institute of Management, to deliver the Director's address and share his vision for the session ahead. Please give a big round.
Good morning. This is, I promise, you're raring to go. I can see you there. So let me just take a few minutes to, first of all, congratulate the organizers for organizing this 35th, in the series. You heard about the origin of this particular event. This is our way of making sure that our students, besides learning from, the books and in the class, also get to really learn from practitioners like you. So it's really, and I want to particularly thank each and every one of you because it's Saturday morning. I'm sure you have far better things to do. This also shows your commitment to really making, educational institutions be more meaningful and be more productive for our students. So thank you for that. The theme itself is quite interesting. When money moves faster than cycles, rethinking portfolio diversification. I think the organizers have a specific reason for this because obviously technology is changing the whole investment and markets, in a very, very big way. I in my past life used to be in the corporate world. I used to face people like you on a quarterly basis as the managing director of BSF India first and later on as MD of PI Industries. And one of my most stressful periods every 3 months was facing the investor call. And I just read recently that now you guys actually record our investor calls, use natural language NLP and analyze the sentiment. So it's not just what we put out as, the balance sheet and the P&L that you look at. You're now starting to look at the senior managements, and that's the kind of technological changes that are happening. And so this really is something that, you know more about. And that's, I think, one of the reasons why this particular topic has been chosen. There are other reasons for this. For example, the geopolitics and what's happening today. Somebody wakes up in the night and thinks that tariff is the solution to all the global problems when economists had proved that actually it's probably exactly the opposite way. And I'm sure when that person sneezes, the whole world today and all the market seems to be catching cold. So that's another very big dynamics. But underlying that dynamic is also the whole effort of polarization of the world, particularly from a market perspective and currency perspective. And I was reading recently about the BRICS payment, the alternate to SWIFT, and one wonders what those kinds of, initiatives and changes that is happening will impact and, impact the market. So, and in addition to that, the biggest underlying theme is the investor behavior. When we were investing, we looked at companies, we looked at marquee companies. That was the only kind of criteria for us, whereas I think today it's not really companies, more themes and so many other factors that are used. So it is for this reason that this particular title has been chosen, and I think we could not have thought of better panel and a better moderator to really take this discussion forward. So I want to again thank you all and thank all the students and faculty here. You will not get an opportunity like this for a long time, so please make the best use of it. Ask all the questions that you have, and with that, I really kind of look forward to the conversation as well. Thank you.
Thank you, sir, for your thoughtful perspective, which has set the tone for the event. Now, we invite Dr. Raghu Kumari ma'am, Chairperson of the Center of Excellence in Capital Market, to address the audience and introduce Investrix 2026.
Can we please greet her with a round of applause?
Good morning, everyone. Respected dignitaries, esteemed leaders, my dear Dean, Director, Dr. Raman Ramachandran, dear faculty colleagues, and my dear students. Welcome you all to the most awaited 35th Annual Industry Panel Discussion, Investrix 2026. On behalf of Center of Excellence in Capital Markets, I welcome you all to this most awaited event. Every year, we choose a topic that represents the pulse of global markets and Indian capital markets. This year, we choose theme, which is When Money Moves Faster Than Cycles, Rethinking Portfolio Diversification. Could not be more relevant. That's what we can feel today now. Traditionally, we were taught that markets move in cycles, like business cycles, valuation cycles, credit cycles, and economic cycles. Investors build portfolios, assuming that these cycles are going to take time to unfold, and diversification was designed accordingly across sectors, across the geographies, as well as market capitalizations. But what is happening now today is we don't see that perspective that one can invest and make a portfolio and forget for some time. That phenomena is fading away. But today, when we say that in this theme, money moves faster than cycles, basically we are talking about with relevance to capital now flowing across the borders in milliseconds, algorithms executing trades in microseconds, news travels in seconds, sentiment changes in minutes, and volatility emerges not over months, but overnight. We live in a world where a tweet can move the entire market sentiment, a central bank comment can trigger global sell-offs, a geopolitical event can reshape the asset allocations instantly. In such an environment, we must ask ourselves, is the traditional portfolio method still relevant? Is it sufficient that we follow such kind of strategies now and then think about wealth maximization? Is asset allocation still a slow and long-term exercise? These are some of the important discussions that we are looking forward in this main discussion. And this is precisely why today we feel that this theme is so important for all of us. Diversification was once taught to all of us that not to put all the eggs in one basket. This is the first lesson taught to all of us in our finance class. But today, understanding this in a new perspective is really very, very important. For example, now correlation, we need to look at it in crisis. We need to look at liquidity in stress, risk beyond volatility, and behavior in uncertain times. This is why we are extremely privileged to have with us today an exceptional panel of industry stalwarts, leaders who have witnessed multiple market cycles, navigated crisis, built resilient portfolios, and managed capital in extreme uncertainty times. To our students, I would say this is not just a panel discussion. You are able to witness a master class in real finance world. Without much further ado, let us embark on stimulating, most thought-provoking discussion ahead. And with this, I formally open Investrix 2026. Thank you, everyone. Over to MC.
Thank you, ma'am, for taking us through the glimpse of Investrix 2026 and what our theme is going to be. The successful organization of Investrix 2026 is credited to the dedicated efforts of Team FinStreet, which continues to contribute actively to student development through various impactful and informative initiatives at this campus. Let us now revisit and reflect on FinStreet's journey and the initiatives undertaken over the years. And welcome to Investrix 2026. where finance is explored beyond cycles and ideas move at the speed of today's market. At KJ Somaiya Institute of Management, this dynamic perspective is embodied by CECM and FinStreet, the finance committee of the institute. Established with the objective of bridging academic learning and industry practices, FinStreet has evolved since the institute's inception under the continued guidance and support of our esteemed faculty members. Learning at FinStreet extends far beyond textbooks. Through structured knowledge-sharing sessions, students develop strong analytical foundations and DCF modeling skills that are applied through live industry engagements such as the Lakhani project. This experiential approach is further strengthened through access to the Bloomberg terminal and the KJSIM Bloomberg Finance Lab, where students work with live market data and earn Bloomberg certifications that prepare them for industry roles from the outset. FinStreet's thought leadership initiatives form the core of its academic impact. Finly, the committee's flagship monthly magazine, features in-depth sectoral and company analysis along with expert insights, and as of January 2026, it has reached its 148th issue, making it one of the most widely read student-led finance publications across B schools in India. Complementing this is the FinStreet Journal, a weekly newsletter capturing key macroeconomic trends, market movements, and corporate developments. Currently, it is at its 250th volume. To foster competitive and applied learning, FinStreet organizes events such as Lock Stock Trade, an inter-college virtual trading competition with a live leaderboard. At the center of these initiatives stands Investrix, FinStreet's flagship investment conference, which has hosted eminent industry leaders including Mr. Vijay Kedia, Mr. Prashant Jain, Mr. Jim Rogers, Mr. Ramesh Damani, and many more. The committee has also hosted a fireside chat with Shri Sundara Raman Ramamurthy, Managing Director and CEO of BSc, offering students direct exposure to leadership perspectives from India's capital market. Building on this strong legacy, Investrix 2026 is centered on the theme, "When money moves faster than cycles, rethinking portfolio diversification." As global liquidity accelerates and market correlations evolve rapidly, traditional diversification approaches face new challenges. Investrix 2026 aims to explore how investors can rethink portfolio constructions in an environment defined by speed, complexity, and continuous change. Welcome to Investrix 2026.
In this discussion, we'll be navigating portfolios in an environment where money moves faster than cycles, offering practical perspectives for the road ahead. And it is an absolute honor and privilege to be graced by guests of such high eminence from the industry for this discussion here today.
It is an honor to host our first panelist for today, Mr. Ashwini Agarwal. Mr. Ashwini Agarwal is a fund manager at Edelweiss Asset Management Limited. With close to 2 decades of experience in the Indian capital market, he focuses on managing equity portfolios through rigorous fundamental research, valuation discipline, and long-term investment approach. Prior to Edelweiss, he held senior roles at JM Financial Services and Baroda Pioneer Mutual Fund, contributing to both domestic and offshore strategies. A CFA charter holder with an MBA in finance, he is known for his research-driven perspectives. We welcome you, sir. Next, we are privileged to host Mr. Saurav Patwa. Mr. Saurav Patwa is the head of research at ASK Investment Managers and brings nearly 2 decades of experience in equity market. A chartered accountant by qualification, he leads ASK's equity research and contributes to portfolio strategy as a part of investment committee. Before joining ASK, he held senior roles at Quest Investment and spent over a decade with HDFC Asset Management. His work spans deep fundamental research and long-term investment decision-making. His thought leadership and market commentary are sought after across industry forums and investor platforms. We are pleased to welcome you, sir. Next, we are privileged to host Mr. Rakesh Vyas. Mr. Rakesh Vyas is the Chief Investment Officer and Portfolio Manager at Quest Investment Advisors. With over 2 decades of experience in the capital markets, including more than 14 years at HDFC Mutual Fund, he has been deeply involved in equity research and fund management across multiple sectors. Prior to joining Quest, he managed the HDFC Infrastructure Fund and HDFC Housing Opportunities Fund. With the Infrastructure Fund receiving the Platinum Award at the Nav Bharat BFSI Award 2023, he is an alumnus of Auxiliary Jamshedpur and holds a degree in electrical engineering. We welcome you, sir.
Next, we are honored to host Mr. Mandar Pawar. Mr. Mandar Pawar is a Senior Vice President at Kotak Mutual Fund with over 21 years of experience in the asset management industry. He has been with Kotak AMC for the last 17 years and currently manages the Kotak ESG Fund and the Kotak Energy Fund. His sector coverage includes oil and gas, logistics, retail, telecom, and select mid-cap spaces. Mr. Mandar holds a master's degree in management studies from the Mumbai University and is recognized for his disciplined analytical approach, sector insights, and long-term investment perspective. We welcome you, sir. Up next, it is our privilege to host Mr. Harshad Boravke. Mr. Harshad Boravke is the head of research at Mirae Asset Mutual Fund, with close to 2 decades of experience across equity research and fund management. His core focus areas include financials, oil and gas, and macroeconomic analysis. He currently manages multiple funds, including Mirae Assets, Balanced Advantage, and multi-asset allocation funds. Mr. Harshad is an engineer by training and holds an MBA in finance. We are pleased to welcome you, sir. To moderate this panel discussion, we have Mr. Nigel D'Souza. Mr. Nigel D'Souza is a senior editor and market news anchor at CNBC TV 18 and has been tracking markets for over 15 years. He closely follows sectors such as metals, materials, derivatives, and financial flows, offering sharp insights across market cycles. Mr. Nigel has profiled more than 300 companies through shows like Midcap Mania and Inside Out. Known for his incisive questioning, he brings clarity and depth to every discussion that he moderates. We welcome you, sir. The stage is all yours, sir. We are privileged to have all of you, and the world is waiting for your insights. Thank you.
Well, thanks a lot for that. Thanks for the introduction. It's an absolute honor to be part of this panel today and to get a chance to moderate it as well. When Professor Sir messaged me close to 10 days ago, I believe that we are developing an equity cult here in India, and to be a small part of that is my responsibility. So most of the weekends, whenever I'm invited, I never say no, and thank you so much, Professor, for making me part of this event. Well, just to drive home the point, sir, when you say that nowadays those con calls are recorded, when we joined the industry, that was 15 years ago, it's almost 15 years on this day itself, and I entered CNBC TV 18, one advice that was given to me was, you're doing a job of a surgeon. So you'll do many successful surgeries. Like, ek mistake, that's the end of it. So now I think it's a bit of an even platform because all the con calls are recorded. Sometimes if, management says something very good or very bad, he's taken to task on that. So interesting times with, the social media exploding. That said, let's get straight to the discussion then. Rakesh, I'm going to come across to you first, with regard to this entire India structural story that we keep talking about. A lot of these youngsters over here, some of them would have joined the college close to around 18 months or so ago. They're watching the Nifty and they're saying, man, what are we talking about? economy is a little bit softish. The markets have not moved at all. And it's difficult when, there is a party going on and you're the only one who's actually sitting in a corner because the rest of the globe is partying. So do you still believe in this India structural story? And tell me why.
Great. Thank you so much for inviting me. A pleasure to be here. As Nigel said, interesting times because if you look globally in equity markets, everyone else is running fast. We have been just logging along. But I think the mood point being, if you look at from a longer term perspective, India still remains a good story. And I'll tell you the reasons why. If you look at all the macro data, which includes the demographics, young population, fiscal deficit containment, I think all of that point towards a very stronger growth profile going forward. However, like in every cycle, we'll still see some moderations here and there. Last 6 quarters, more or less, as Nigel talked about, has been far more challenging for us. But it's also come on back of 4 very good years. I mean, those were the best years in last decade or so. If we still continue to believe that India being one of the fastest growing economies going forward as well, it will actually be driven more by the earnings that will come from the corporate side. Also, as I talked about, government action around lot of policy measures, which is actually to contain interest rates, and therefore if you see now interest rates are lower, inflation is lower. But overall, in my view, if you see from a next decade point of view, India among all countries will still come out as one of the fastest, and it will reflect in equity market returns. Also, one has to be far more patient in the market cycles in general. I think a lot of younger generation actually has come post-COVID when they actually saw 4 very, very good years of market returns. But if you go back in cycle and if you analyze the markets across 5-year periods or 10-year and 15-year periods, you would probably see market giving returns of close to 13 to 15% across various market caps, and that all is backed by mostly the corporate earnings. And therefore, the belief that as we move forward, the overall growth story of India continues to remain very, very good. And I still see very good prospects over next 3 to 5 years. Near-term hiccups, we just have to take in stride, in my view.
Okay, par for the course then, these near-term challenges. Ashwini, coming across to you then, that period, those 4 beautiful years, actually it was a spoiler for a lot of these young investors because they never saw the bad times. They came in 2020, I had a colleague of mine who said, Nigel, I'm going to buy this bike. But I said, there's a funding gap in there. He's like, hey, equities mein dalega, 20% vase milega, so it'll compound at so much, so and so. And that never happened. So that period between 2020 and 2023, when everything moved up, that was actually a bit of a spoiler. That said, at current reckoning, what is your view? Because the hope is that 2026 is going to be a much better year than 2025, at least with regard to economics, at least with regard to earnings as well. But just look at the start. 17 days in, you have a head of a country that's been picked up from his bed. You have tariffs, there's no solution that's come on that front. And, you had a bit of a ruling yesterday with regard to some of that foreign investment in India as well. I'm talking about the Flipkart case. So your take on that.
So just thanks a lot first for having me here. I'll just give you some brief background. In 2020, globally, we had to loosen the monetary policy and the fiscal policy to accommodate the entire population and to stand against the pandemic. But in 2023, all the central governments and banks realized that the immense liquidity which has been floating around need to be revived. So, and there were a lot of excesses being created in the markets, if you see. People were taking personal loans and investing in markets. And if you look at housing loan was available for 8.5%, car loan was at 9%, and personal loan was at 10 to 11%. So the risk gradient in terms of pricing and overall had gone for a toss. So the slowdown which we see in the last 24 months or 18 months is more like a self-inflicted one, which was necessary. It is not a slowdown. It is just rewinding of the excess liquidity and excess growth which was there from 2020 to 23. And that's why at that point of time, the average market cap to GDP for India was in the range of 70 to 75%. That's where we traded for long term for last 20, 25 years. But suddenly now, we went as high as 140% market cap to GDP, and even now we are in the range of 120 to 130%. So in 2024, interest rates were increased from 4%, from repo was increased from 4% to 6.5%. Now that has come back to roughly 5.25%. Your 10-year GSEC is down by 100 basis points to roughly 6.5, 6.6. And liquidity, which had become negative to the tune of 2 lakh crores in the banking system, is again positive. So if you look at all the things and the credit growth, now we're also talking about liquidity here. So it is liquidity which drives the market, and it also drives the business cycles and the corporate earnings. So, and banks have also started to lend again. The credit growth bottomed out roughly at 9% in the month of August last year. So if you see, all the macro headwinds are behind us, and we have reversed the trend, and we are there with the favorable macro trend. So yes, definitely 2026 should be better than 2025 in terms of corporate earnings. If you look at the EPS cut, which had happened in the last 6 quarters, bottomed out mostly in the last quarter or in this quarter. This quarter may have the least EPS cut. And henceforth, 2026 should be fundamentally a better year for the corporates in India. The global headwinds remain the joker in the pack. Because if you see, even in 2008, or especially in 2008, India fundamentally was doing well. We had no problems as such at the domestic level, except a cyclical slowdown. But it was the global which impacted us, and which we were out of the woods very quickly as well. So yeah, the global may dampen the equity markets, but fundamentally we are much better placed in 2026 as compared to last year. And I think it's most important to remain invested in the equity markets, because this tariff problem may get solved within a short span of time. And that point of time, market will not give you time to get invested.
Right. That's an important part, the tariff point particularly, because getting into this year, I put out a poll with regard to when do you think this tariff is going to get solved? 3 months or 6 months? Majority of the people said 3 months. And the last 20 days, the panels that I've done, I've also heard at least we'll get it in this calendar year, maybe towards the end of the year. There's another scarier one. At least in his term, we will get this resolved. That is 3 years hence, which is, obviously a bit of a worry. Mandar, coming across to you though. Markets go across cycles, right? Various cycles. And sometimes we go through extremes, right? So there could have been peak euphoria that played out, say 18 months or so ago. And maybe in fact, the kind of talk that you're hearing, pessimism is creeping in. I like that, because in the past, when we are heading towards peak pessimism, actually that's when things turn. Shankar's come? No, okay. So how far you think we are from that extreme? And it's very important, to catch these extremes.
Thank you, Nigel, for that question. And thank you to the management of Somaiya College for inviting us and giving us this platform. Now, of course, the market will keep swaying between the extremes of the euphoria and fear. I think we are not at the either of this extreme point. Of course, not at the euphoria point, but not at the extreme pessimism either. Because I think what we are, as you rightly said, as we started this year, it has started with optimism that probably this is likely to be a turnaround year where we'll see the earnings coming back. And once the earnings come back, you also expect that the foreign money will also come back. I think, what one also needs to put in context is, okay, we are missing out on the party, but who has joined the party, right? China market started doing well. But what has China done for the last 15 years, right? The market had gone nowhere, right? The peak was way back, 15 years back or more than that. There is some kind of a rotation of the choices of market that the FIIs have gone through. If you look at the buying selling pattern, of course, you see FIIs selling, DIIs buying, right? So it's not that DIIs are also selling, right? So there is at least one section of the market which believes there is optimism there in the market. I think it is more to do with how the valuations have corrected. At one time, or let's say these 2 years back, we would be trading at what, 24, 25 times on Nifty and close to 30 times on the mid-cap index, right? And where you had China at 12 times. I think it is more the correction which has happened, which was triggered by the the economic slowdown, and last 6 quarters is where we have seen the corporate profits grow in single digits, right, from 14 to 15%. Is that bad? It is definitely slower than what it was 6 quarters back, but I don't think we are in a fear where it looks structural. I think it is more cyclical, as we are talking about. All said and done, we are not growing at 8%, but we are still growing at 6.5% at the GDP level, which is definitely beating other markets. So I think the structural story of India is intact. So therefore, I don't think we need to go to that extreme of fear. Okay. At the same time, what we are seeing, the retail participation to some extent had softened after the March 24 peak, or the September 24 peak rather. Now, what I believe is, the market is not too leveraged. If it is too leveraged, you get into those kind of capitulation kind of phases. We are not witnessing that. So I think what we are witnessing right now is a healthy correction. I think it is bringing the valuations to more sanity level. Now, if we see the earnings coming back and we are more hopeful of that, then I think the money will flow. The fundamentals are intact. I think there is no debate on the fundamentals at least. It's a question about how you get the earnings back. Government has tried everything to revive the consumption, but probably what is still lacking is how the investment cycle picks up, because that is something where market will be again watching very closely on the budget as to what can be done to revive the capex cycle. And I have a lot of optimism there also, because if I look at the capex, there are three engines of capex, right? There is central capex, state capex, and the corporate capex. Central capex is constrained, state is more or less flat for the last year because of the kind of freebies, distribution, etc. But I think corporate capex is coming back. You take out the top two who had spent a lot on their 5G expansion, and then you see what has been the capex cycle. The corporate's capex is growing at about 9 to 10%. So that brings that optimism back, that market will rebound from these levels. And this is something where I think it will test the patience, but that is something where I don't think we need to fear we are going to an extreme of this growth story in detail.
All right, I think a very, very valid point. We're seeing signs of private capex coming back. The government as well has said we have done the heavy lifting till now. Now we need the private capex to come back, and also the other point which Ashwini made as well. When we're seeing credit growth come back, that's one of the indicators, right? Because that things are actually on the mend, which is good. And this entire talk about, we've not been part of the party. Who's the dancer out here among the batch? Any dancers from the boys? Which one? Anyone? One of you all, if you all can put your hand up. Aryan, you're the dancer. Aryan, right? Aryan, sometimes you go to the party and you don't dance immediately, or you dance immediately? Sometimes you dance a little later as well. I would like to take that example and say India is not yet dancing. We're just part of the party. But once Aryan starts burning the dance floor, there's no stopping him. All the ladies are saying yes. All right. Sort of coming across to you. This entire mood, all these, the kids over here, they would be feeling we're in a good place. And they would be tempted when they get their first salary, to go ahead and allocate some money to the market. And I could tell you guys that I missed out. Back then when I was a student, when I got my first salary, I bought a Royal Enfield. I didn't buy the stock. It would have been much better place today. But I think allocating some part of those first few salaries, get into that, habit of putting money into the equity market is very, very important. So sort of, Wayne, how do you convince this audience, that we are there, things will actually play out ultimately, and equity will be a preferred asset class in the many years to come, because they are all of 2025 approximately. And the runway is tremendous for India. We know that. It will flow into equity markets, right?
Thanks, Nagel, for the question, and thanks for inviting me here. Great question. See, the way I would look at it is, in last 75 years since we have got independence, India is close to be the highest per capita income as of now. And if you drill down this further, the age group which actually has the spending power, which is maybe 40 to 50 and above, they are actually at a much higher per capita income compared to the past cycle. And as we go ahead in the next 2 decades or so, this cohort is something which is going to increase. And in general, this, and then you compare the another thing which is there. Historically, India used to save through gold, through FDs. through traditional means of savings. That is changing. The people have started investing in equity markets, and they've seen the fruits of it. While last 1 year or so may be a very short example when the markets have not done well, but and there can be various macro reasons because of which they could have done that. But if you go back in time and see last 40 years since times the Sensex is there, 45 years since the Sensex is there, world has seen a lot of macro events which were always termed as the end of the world types. Like there was oil prices when the Sensex oil prices shooting up in 1980s. Then there were multiple scams which rooted the markets in India. There were multiple wars. There were macro events, global crises like Asian crisis, Lehman crisis. We saw COVID, and all of this through. Still, the market is where we are. And if you go back, why this has happened? See, it's not that all the companies which were listed during this period, they went through this. There were companies there were managements who genuinely put efforts to generate good returns from their businesses, and which is what eventually reflected in the stock market's returns as well. So key is that equity market investing is essentially investing in other businesses which we understand and we like, run by managements which are capable enough. So if we are able to identify those businesses, identify those managements who are able to do that, in the long run, eventually all of us who are investing in those markets will make money. And luckily, unlike other asset classes, this is an asset class where you can actually take use of professionals. You can invest in bits and pieces through SIPs, through STPs, whichever mode works for you. So, but the important thing is to have discipline. Important thing is to have patience. And patience again is required in both two phases. Not only to remain invested, patience to not invest in something which you don't understand. One should invest in what he understands, where he's invested in, and invest only where he understands. These are two critical aspects where one should be very critical. One should invest in. India, if you ask me why India is the right place to be, demographically, this is actually one of the very few countries who actually still has a growing younger age population, which means the consumption economy can continue to do well. India is actually one of the very few nuclear powers who are run by a democracy, which means we can defend ourselves well, which is also very critical in the current scheme of things where the geopolitics are very can turn things very swiftly in near term. So given all of that, I think India is the place to be. Equity is the place to be invested. Of course, one should invest in other asset classes as well. They are also equally important, but a large portion of investment should be in equities, because equity is something where you invest in businesses which can grow. Growth is the key.
Indeed, sort of good point out there. And Harshad, I'm coming across to you because you're closest to me, so I said I'll keep it for last. But just to give you an example, an asset allocation, Ajay, I'm looking forward to hearing from you because that's something that we want to discuss as well. But I recall during COVID, everyone felt the world is coming to an end. And if I remember correctly, it was 28th of March in COVID year, and there was a larger HNI who I saw he had sold on the screen. It was reported in the bull trade. So I spoke to him, I said, sir, you have been talking up the market and this is fear and typically you get in here. So he said, Nigel, I'm not sold, I've transferred it to a trust, which means that he still holds those stock. So then I said, what about, the outlook from here, I think the market was 8,500, that's nifty, so stocks were down far more. He said, I'm allocating money tomorrow. So I said, but why? Everyone's so fearful. He said, see, Nigel, two things will happen. Either I'll make a lot of money or we all won't be there tomorrow. So I rather go with the first option, and he went all in. And today, in fact, that particular HNI is, if I'm right, close to around $1 billion or thereabouts, which is, tells you at times like this, actually, it provides you with an opportunity. Harsha, that said, your team, you would be going through various data points as well. With regard to this India runway, with regard to what's going wrong as of now, because the start has been very whimsical. On a day-to-day basis, we hear about this year going to be better. That's not really played out, at least as of now. If you had to pick and point, a couple of key areas that you would focus on for this year, and if you could also tell me what is the biggest risk, according to you, to 2026 actually getting further derailed?
Sure. So, okay. So before what could go right or what could go wrong, let's try to assess how the last 2-3 years and what really derailed or so-called derailed India story, or why there was a market, correction. So post-COVID, obviously, a lot of pent-up demand was there. Many sectors did well. Government also was supporting a lot. Globally, also, a lot of money flows are happening. FIs were still investing at that point in time. But obviously, it resulted, into inflation going high. So to that extent, the slowdown which we saw, particularly in the last 2 years, that was more towards consumption, particularly urban consumption for that matter. So if you look at when we started FY25, as a year, so in equity markets, as you know, markets move on a forward earnings basis. So we started saying that FY25 Nifty earnings will be 12%. We ended FY25 with Nifty earnings of 3%. So the whole debacle from 15% to 3% is and can be attributed large part of it to the consumption, going down. Yes. Now the question is it coming back, right? So if you look at, government obviously identifying that, government prior to 25 was focusing too much on infra capex. So if you look at Indian infra spending in the government budget for that matter, it used to be like 3-4 lakh crores, went up to 10-11 lakh crores, double digit growth for 4-5 years. But at that point in time, there was, consumption which suffered. So government in the last 1 year particularly has done a lot of things. Last in that was, GST cuts. Now coming back to your question, FY26, the key question to address is, will consumption revive? So if you look at last, as Mandar said, last 6 quarters, we are having a single digit growth, particularly Nifty or, top 100 companies. I think I would be in the camp of thinking that there will be revival. Why? I think the way it works, for example, let's say income tax cut, which has happened. So people typically would take 6 to 9 months to, decide and, move into mode from saving to deleveraging to actual spending. If you look at last 3-4 months, obviously there was Diwali, which happened. But there are some signs of comeback of consumption. That's point number 1. Secondly, if you look from the data points point of view, if you look at bank credit growth, right, it went back to higher single digit. Country like India with a 6.5% GDP, a single digit credit growth is not a good sign. But now we are back to, I think, 14-15%, the last number which came out. I think now that there are signs, there is a revival which is happening. There is a government which has identified the problem, and they have done multiple things in the last, 6 to 9 months. So that is one thing which I think is coming back. Second, which I think Mandar touched upon, the private capex. So if you look at India Inc. as a whole, and if you look at try to analyze balance sheet of top 500 companies, sectors like steel, which used to be notorious to have, a lot of debt to equity. That was the first ratio which used into steel companies. Yeah. Now steel companies are cash rich. It's unimaginable kind of scenario. So India Inc. in the last 5-7 years, whatever earnings happened, post-COVID, everything went into, kind of strengthening the balance sheet. So I think consumption will come back. Credit growth is already started to come back. And next trigger, which I think is the private capex coming back. So all put together, and I think that is also reflected in the earnings. So FY26, obviously, we are looking at some 10-12% earnings growth, but FY28 earnings, we are looking at 16 to 17% earnings growth. So I would be in the camp of, positive, and I will wait for revival. Maybe after 2 quarters, we will be back to a double-digit earnings growth. That's what I think.
What's the risk to this thesis, though?
I think the risk
to earnings. Earnings come, results will be there.
So I think domestic, I'm not too worried, if you ask me frankly. So starting, always, the point is what is the starting point, right? So I'm not paying too much. If you look at Nifty available at on 1 year forward 20-21 times, which is a long-term average. So my starting point is not bad. But point is, for me to make, good double-digit returns from here, I think I'll also need some support from the global macros. So which I think right now is a question mark.
Indeed. We look inward, but as we finished that first round, everyone had a were to come. And there are a couple of positives that I think we should all note out here. Credit growth is picking up, which is good. Private capex is picking up, which is good. India's per capita, income, that's perked up to a goodish extent in the recent past, which could spur further consumption from here on. And put all this together, earnings will come about, and markets ultimately are a slave of earnings. So once earnings come about, we should be in for better times. Sort of coming across to you, though, yet again, we hear about these themes, various themes which are going to do very well. Railways, defense, chemicals. There are a lot of themes out there. If you had to pick up a couple of them and just explain to us, forget about stocks, but about the runway, which one would it be if you had to stress on one or two of those themes?
So one thing which are just clearly, which are clearly visible, and I just talked about briefly in the previous question also, is when I look at defense, if you go back in last 70, 80 years history of global history, the countries which were able to sell their arms were the countries who actually were able to demonstrate their use. This is an unfortunate thing, but that's how it has happened. If you go in, and the real reason for that was that these were the products which actually were war tested. No country wants to buy an arms which actually they don't know whether they will work when they are needed or not. That is one reason and Operation Sindoor let us test those products, and which now the world has seen that what our product capabilities are. That is one reason why I think there is this the export prospects of these products have become for India. Second, and another, and which is again very, very critical, the kind of world which we are living in is not something which was there maybe last decade or so. The world, after the Cold War, there was 2 decades where the world was largely at peace. The only country which could actually could do some things here and there was the US. And however, things have changed in last decade or so. Started with Crimea when Russia started accenting the Crimea. Then there was COVID, so things were done. Then actually again Russia again started doing the Ukraine thing, and then Israel, Iran, and now India, Pakistan. Then always the threat of China and Taiwan. So every country now needs to have its own defense systems, which should be very, very capable. Good thing is in last decade or so, almost all the large defense companies in India got listed. So we have an opportunity to participate. And this is something which you will want a global tech know-how JVs, but still you would always want to retain it with the Indian companies, especially the government one. And government is now actually even open to give parts and bits to the private sector as well. So I think this is an opportunity which one should look very, very closely and keep an eye on. And when that, obviously there would be, you need to do much more deeper work and research to identify bottom-up companies. Another thing which to my mind is very, very, which is the changing consumption pattern in the country. And you have to look within, and this is how it has happened globally as well. Again, the consumption pattern changes again with the time, depending on the kind of economy which we are, we have to look at that. See, India is a country where there is a labor arbitrage optionality. And which means that there is a lot of people who are unskilled, but they still want to earn, and which creates an opportunity in terms of people who actually have money and want convenience. So convenience-led economy, discretionary well-being-led economy, which is these are the themes. So whether it is hotels, good quality hospitals, which people would want to look for as people get over, as our country is becoming older, but at the same time becoming slightly richer also. We would want good quality hospitals. We would want good quality hotels and resorts. We would want to spend their time as a family. We would want more convenience-led consumption. So a traditional consumption thoughts, which were like, say, buying premiumization in terms of products, that is now changing towards more experience-led discretionary spending. So these are the few things which I would want to look at and do a more bottom-up research in these themes to identify better companies within this.
Interesting points, yes. I mean, in terms of those experiences as well, I had a family of 4, and I didn't, push as much as these kids today. There's a Papa, where we going for Diwali, Christmas, Holi, limited money. but, but anyway, just I think the government as well has played a very, very important, part in this entire focus on the steel companies. For example, Harshad said that, the steel companies today are in far better shape. In 2015, I recall that steel companies were under big pressure. The government came in there, they noticed that this could go out of hand, they put in an MIP. In the last year, Chinese exports of steel just continued. Chinese market, by the way, is close to around, maybe around 6 to 7 times the Indian market in terms of capacity. And with China exporting 10 million tons every month, irrespective of what the world does, steel prices will be under pressure. So this government as well has been proactive on a couple of sectors. And that's been very, very good. Defense, steel, just to name a few. Ashwini, I want to come across to you. We as well, as market commentators, we talk a lot about this FI selling. But just take a look at the money that's come into banks and financial institutions just in the last 6 to around 8 months. That's showing you select assets are drawing money from foreign shores as well. You want to come in on this?
So if you look at, for us, I think financials is one of the themes, as you asked earlier. And definitely, if you look at, a lot of money will keep on coming in the banking and the financial sector. Just to give you some anecdotes, the total loan book of the banking system is roughly 200 trillion rupees. That's roughly 50% of the GDP. The NBFCs would be roughly 12 to 13% of the GDP of our country. And there is a lot of underpenetration, especially in the retail category, SME and the MSME category. If you look at the Indian bond markets, corporates which are lower than AA+, they don't get money from the bond markets. They have to go to the banks to get money, right? So there is a big scope for penetration there. Now, if you look at just 6 years back, we were roughly 4 crore demand accounts. Today, we are 19.5 crore demand, 20 crore demand accounts, give or take there. From a 20 lakh crore AUM, mutual fund AUM, we have reached to roughly 80 lakh crore AUM in the mutual fund. Still, we are roughly 20% or 21% of the GDP. Whereas if you go to the developed markets, that number is something like 150%. The US mutual fund are roughly 150% of the GDP. So I think there is a long runway for this entire segment. And currently, if you look at in the last 6 years, there has been a big behavior change. Earlier, investors used to think that equity market is more like gambling, and equity market is not for everybody. But with new apps coming in, with new all these fintechs coming in, investment has become a lot more easier and seamless. So a lot of money has been going there, and in 2020 we could see a behavioral shift because of all these reasons. It helped the entire financials. Now in a savings account we get 2.5%. We are lower. We are not beating the inflation there. If you look at the inflation of roughly 1%, that inflation doesn't belong to us. In the CPI, the way it is calculated, at roughly 40% is the food basket. Our inflation is much more than what is projected or what is perceived in the market. In an FD, you get 5 to 6%, which again, it is just there about inflation. It is only equity market or gold which is giving you a return where you are beating the inflation. So I think the investment market or the investment segment is there to grow. So if you look at all the themes, financial segment of the market will continue to grow for the next 20 to 25 years or maybe more. So anything where you have a good runway of 20, 25 years, the banking balance sheet is in the best of the health in the last 15 years, the corporate balance sheet is the best of the health in the last 15 years, and all the bad assets have been written off. So I think it will attract a lot more money going forward as well, both from the domestic side and from the foreign side, because runway is huge and profitability is there.
Okay, so financials and banking theme, that's something that you continue to bet on. Mandar, I think you want to come in as well. In terms of a theme that you like, so we have had defense, we have consumption, experiences, banks as well. Anything different?
No, what I would say is, yeah, defense, I would expand that basket a bit and call it a overall manufacturing base. Right now it is kind of moving into some kind of a slump because we talked about how the capex cycle has been slow for the last couple of years. But what I believe truly is, if you look at the long-term story, there is a very strong case for manufacturing as a percentage of GDP to go up. Right? So whether you call it the Atmanirbhar Bharat or China plus one, or India has an alternative to China, I think those are some of the core reasons where the manufacturing focus should be there. Do we have the environment for this? I believe yes, because as at some point we discussed, how the leverage on the balance sheet of corporates have come down, NPA cycles are at all-time low, the bank is ready to finance the projects, and the startup culture which has come. So we have also seen not just service orientation but also manufacturing orientation. So I think manufacturing is something where I do believe there is a long runway for growth. And for a patient investor, I think it will pay out rich dividends. I am very sure about that. Consumption is the other theme where again I'm positive on, but I will be little cautious of going overboard on that. I'll be very choosy on consumption side. The reason being, all the demand drivers are there. Young population aspiration levels high, income levels growing. But what has also come about is the competition intensity has gone up, and the reason why it has gone up is, I think, somewhere by competition intensity going up, of course the pricing power comes down, but the entry levels have gone lower, and that is what is contributing to this. To create a brand, I think in the today's age of electronic media expanding and the social media, I think creation of a brand has become easier than, let's say, a decade back. Creating a distribution network, you have found an alternative in e-commerce and you are reaching directly to the customer. You do not spend years building a distribution network. So, we have seen examples of how some of the D2C brands have grown over the last 2 years and how they are grabbing a large part of the market. So the competition angle would probably keep the pricing power in check, and that's why on the consumption side I'll be little choosy. The market will expand, but whether it will mean exponential or a healthy growth for the players, I have my doubts. So therefore, I think I'll put manufacturing as something which I am little more confident on with a little longer horizon. Consumption, yes, I'm positive, but I'll be little more choosy there.
And manufacturing as a percentage of GDP, if you could give us a number?
Yeah, so manufacturing as a percentage of GDP today, we are somewhere at about, I think, 14 or 15%. I think the aspiration is to take it to 25%. I think that is what the government machinery is working towards. No doubt there are challenges in terms of execution at the ground level, and that will remain in a country which is democratic like India. We are not China, right? So there will be challenges which will be there. The pace will get altered, but I don't think the direction gets altered. Okay, so I think we will be moving in that direction. Delays of few years is something that one should be taking into account.
Okay, all right. Rakesh, coming across to you then. What do you think stands out in terms of a theme? We've spoken a little bit about consumption. Everyone's a little bit selective out there. Defense, financials, manufacturing. Anything different? And, Arshad, I want to ask you as well about tech and AI, because that's obviously... But Rakesh, you go first.
No, I think broadly, most of the themes have already been discussed. I think financials are backbone to economy. And I concur with what Mandar said, and I'll just also highlight to you that if you look at the corporate earnings from FY 20 to 24, the period that we talked about, which was very, very strong, you dissect that, it was not driven so much by volume growth. It was actually more driven by pricing power, was also backed by much more cost efficiencies, because as people and industries entered into COVID period, they started to basically optimize cost, right? So if you go back, if you check the service-led industry, for example, hotels, the manpower to room ratio used to be in excess of 1.2, 1.3. That during COVID period came down to maybe 0.5, 0.6. We still haven't reached to 1 yet. So lot of this cost efficiency actually led to margin expansion. Pricing also led to revenue expansion. And then as I think it's been talked about, the deleveraging of balance sheet across the board, right? Because what also happened was that with the kind of new regulations that came in, people did realize that if they have leveraged balance sheet, they can actually lose their business. And that's the reason why when you look at the behavior of corporates since then, they are far more amenable to raise equity rather than raising debt. And all that led to deleveraging of balance sheet, which led to below EBITDA margins actually expanding further to the PBT. So if you look at all of that, I think we already had a very strong period of very high earning growth. But as everyone has been talking about, policy actions that's taken place, which is in terms of income tax cut to begin with, then RBI's action around liquidity, interest rate cut, and then this GST reduction. It is all to drive consumption, and it is all to drive volume. I'll just give you an example. If you go back and see what were the two-wheeler volumes in 2019, which was the peak earlier, it is this year that we are crossing that peak, which means that on a broader level, the industry did not need to actually add more capacities. But I think as this volume come back, the earnings, the revenue, all of this will be driven more by volumes, and that's the reason why India, being such a large market, will have to put up new capacities. And also, I think the impetus of government, in my view, during this budget, should also be on helping the corporates to put up new capex, because I think lot of spending by government is already being done. Like what Harshad already talked about, if you look at between 2019 to 2024, the India government, central government capex moved from 3.5 lakh crore to close to 9.5 lakh crore, maybe 25% CAGR growth. But since then, in next 2 years, which is between FY24 to FY26, the budgeted increases maybe 8-9%. So I think government has done its bit on capex. The heavy lifting now has to be done by private. My view is, and I concur with Mandar fully over there, I think it's a theme which is much longer term in nature. It will be backed not just by the consumption, but will also be backed by financials. I'll probably play all three themes, to be honest. I still think that, as I started initially with, India still remains a very, very strong growth structural story, because demographics are fantastically placed for us. We just need to be far more patient on execution, but we are probably moving in right direction.
All right, the onus is on you all, guys. Demographics in our favor. Just one point, Ashwini as well as Rakesh, I want to ask you all, gold financiers, do they still find a mention? Because the way you look at it is these stocks have already had a big run. But if you want to play gold in another way, and if you're positive on financials as well, cost of borrowing could stay lower, gold could stay at these levels or maybe move up. Gold financiers, will they find a mention?
Okay, gold financials run because of two reasons. First, gold itself. And secondly, if you look at MFI category loans or personal category loans, they are yet to pick up. So as a central banker or as a government, you will not try to squeeze in that strata, right? So they will require loan in some forms. And if you give them MFI loans or personal loans, the leverage can increase exponentially. It all depends upon the lender. But when you are giving them gold loan, it is capped to 75% of the LTV, or more like 70% LTV of gold. And if gold prices rise, then the further loan can be given to them. So currently looking at the scenario, even though the gold financials have increased, the shares have run up, but I still would go with gold financials for the time being, even though the valuations are a little on the higher side. But yeah, the upside may be capped for quite a few of them.
Okay, Rakesh, you want to come in?
Yeah, so you just have to look at the reasons why gold financing is done. Partly, I think Shuni already talked about. But two primary reasons is my view. One is maybe it's related to consumption, the immediate need for consumption, and you just want to manage your cash flows. The second also is to drive your business growth. And I think the second part is where, as the formalization of this credit cycle continues to go through, we'll probably see other modes of getting that funding into the system. Having backed by gold prices, gold, as we all know, precious metals have actually run up meaningfully over last maybe 12-15 months. One need to be slightly more cautious on the overall valuation, because if you look at asset classes in general, they have, as was talked about earlier as well, they also go through cycles. But if you look at last almost 3-4 years, it's been very few times when all asset classes have been going up at the same time. So you look at interest rate, they were going up, markets were going up, real estate prices were going up, precious metals were going up. So I think it was a very peculiar scenario in which all these have gone up. Precious metals may still continue to find their place in the system because of, as you talked about, US and president tweets, etc., uncertainty, global environment will probably keep precious metals at a reasonably higher price levels. But given that context, I'll probably prefer playing through more diversified financials than going through a direct theme on gold financials.
Okay, and Rakesh made another very important point with regard to looking inward, the cost of production, the cost as a percentage of your sales. I visited a few manufacturing units in my short career as well. I've been to various cement plants. In the south, I've gone to Sagar Cements, and in the north, I've gone to Mr. Bango's unit as well. And their entire focus is on their cost side, which is always encouraging because you can do what you can do. The selling price, it may be not in your hand, but at least the cost of production, if you keep it very lean and, that's what could help you in the time to come. And the other point on automobiles, I recall speaking to Mr. Ramdev Agarwal, and he had made this point with regard to China. The automobile production went up by 2x the per capita income in China. So that went double, but the production went up by close to around 4 times. I think he made this point around 2 to 3 months as well, just recently in an interview that we were doing on CNBC TV 18. But Harshad, coming across to you, I wanted to hear a little bit even about AI and tech. If I'm not sure whether it finds a mention, but you could give us your top theme and also how far behind are we with regard to AI and your view on tech from here on. Because when I was doing my MBA at that point of time, we heard about these beautiful stories about TCS, Infosys, Wipro, well-run companies, good balance sheets, returning money to shareholders. Last few years, you're only hearing those stories. What about the stock prices? It's not really moved. So what's your view at current juncture on these names? Well-run businesses, still very, very well-run, but the growth remains a little elusive.
Sure. So if you look at on the tech side, the whole value chain, and particularly last 1.5, 2 years. So when you say tech, so obviously in Indian IT companies come to the forefront. But in the global context, particularly in the last 2 years, tech was more about AI, tech was more about chips, right? So if you look at the markets which did well, where US, the Magnificent Seven, what we call it, Taiwan did well, South Korea almost doubled. So all this was driven by AI-led themes. India obviously was absent in that. So to that context, last year on the tech side it was long these countries and India basically absent in all these themes. But if you look at the value chain, within AI, I think one is either the innovator or manufacturer, and then there's somebody who consumes it. So as a country, I think we are more on the consumption side, we are more on the implementation side. So all the Indian IT companies are more on the implementation side. But on the innovation side, we are up till now not there. Maybe in the next 10 years, 15 years, it could change, not obviously in the next 5 years. So coming to a question on the Indian IT companies, right now I think obviously there's a lot of flux which is happening. If you look at their business model, it is more about number of people into per hour billing. That's how the business model is. But I think incrementally it is changing, or it will change. It will be more solution driven. Indian IT companies in the last 15-20 years, every time there is some change in the technology, so they have put up to the challenge and went through it. Right now it's a double whammy. It's more also AI driven uncertainty which is happening. Even US companies are not able to figure out whether really they should spend, not spend, or if they have to spend, how much to spend. Even Magnificent Seven, which I was talking about. So if you look at last 15 years, so there was a beautiful correlation between the earnings which they generate and their stock price. But for them also now the business model is changing. It is now moving from asset light to asset heavy. So they are spending upwards of I think $500 billion on these data centers and all, right. And if you look at the returns on the data centers, is like kind of question mark for now. Right now, yes, it is required. It is very much there. But eventually, I think it will become a typical like an utility like telecom. So telecom, once upon a time, we used to pay some 10, 12 rupees per minute, right? But now it's a simple utility. So maybe data centers will become, but right now it's innovative theme. So it's kind of working. So Indian IT companies, I think it's more about they need to change the business model. They will have to change the business model. But the good part about is I think the whole world is in the phase of figuring it out. So AI, yes, people are trying to do something about it. There is definitely a benefit in terms of productivity. But eventually who will be the winner and who will be the loser, I think for now, I am not too sure on that part.
So maybe IT still has a period of consolidation, a period of rethink to go by. That's the way you look at it?
Yeah.
And if you were to give us then another theme that you believe that still will do well, what would it be? I'm not hearing any about those fancy themes, EMS, those stocks that did very, very well. It's not come on anyone's radar as of now, at least. Or maybe an ignored theme, like maybe a staple company. Anything
No, I
anything
think
that comes to mind?
For me, the theme again could be discretionary consumption, and maybe to some extent select financial names where valuations are quite reasonable. Staples, obviously, I like staples. That is one thing which may not change for next 20 years. But the only issue with the staples is the valuation where I start with. So I am not putting it in theme in terms of investing. Yeah.
So Harshad, let me put this point then to you, with regard to this point on staples. A staples company at 50 times or an EMS company at 50 times. One has tremendous growth. The other one has tremendous stability and is totally ignored. What would you go for at this juncture?
I think between these two, staples.
All right, interesting, because there are so many companies. If I look at a Dixon, I look at an HUL, there are opposite ends. 50 actually will be cheaper for Dixon. I think Dixon is little higher. Ashwin, let me come across to you though. In your career, you would have had various things that you have done which has helped you shape your career. So if you could share with our audience, either that book that you would recommend or that practice that you do, something that has pulled you through all these years, something that you could share that could inspire our audience.
In investing, I think discipline is the most important thing. Sticking to the fundamentals, not getting swayed away by the markets. People think that investing is all about markets. I think for me rather, or it's more roughly 80% fundamentals, analyzing the company, analyzing the business, and the last 10-20% maybe the markets. Valuation is definitely important. But being disciplined, that in the last 3-4 years, many companies came in with not great cash flows, but not great return ratios, but their valuation were out of the roof. So staying away from those kind of investments and sticking to your fundamentals, being disciplined, that's the most important thing. And regarding the books, as we talked about COVID, as we talked about 2008 crisis, how you handle the tough situations, that matters most in life and investments. So I'll recommend 2 books. The Black Swan Event, that's a fantastic book. That's both for life and for investments. And second is a book which is very crisp, that's written by Mr. Bharat Shah, of long-term value and wealth creation. So these 2 books are really good to go.
Okay, all right. Discipline and a couple of books as well. Hope you'll have noted that down. Rakesh, coming across to you. It's a very valid point actually that Ashwini made, because in that euphoric cycle, an order win was appreciated. At that point of time, revenue growth was appreciated. And I think people were looking first buy, then study. That's totally changed in the last 18 to 24 months, because suddenly this talk of cash flows, that order win doesn't get any reaction, it gets ignored as well. The ticker could flash it, but the stock reaction is not. Then a lot of times from a media perspective, you'll tell your team, please get that management. You have the management column and said, do they want me to comment on this particular order? So that's when you realize that these order wins are actually being ignored, and the market is in a far more mature stage where they want to see cash flows. That said, Rakesh, in your career, what's pulled you through these times? If you had to share one piece of advice with regard to a philosophy that you have followed, something that's helped you, and if there's a book, if there's a movie that you'd like to share.
Thanks. Great question. So let me start with what pulled me through over last 2 decades or so. First is, in my view, it is very critical that whenever you look at any company, you need to understand the business, the drivers of the business, because unless you have good grasp on that business fundamental, you probably will not be able to make good justice either in buying or selling. The second aspect that you also talked about, people normally look at P&L more, not so much on cash flows and balance sheet. I think cash flows and balance sheet actually tells you the story of the company. So if you look at and from that aspect comes the return ratios, which are even more critical as to every capital that get invested in the business, what is the returns that you are getting. And in that context, when you talked about EMS and staples, the growths are very significantly higher in EMS, but that is coming at a cost of balance sheet. So except Dixon, who actually hasn't raised capital, if you look at all other names, they have come to market to raise capital for growth. And therefore, it has to be seen in the context of that multiple and the requirement of capital henceforth. And in that context, again, the capital efficiency, the productivity, all of that comes into picture. So I think it is far more important to understand business, understand cash flows, understand balance sheets. I think the 2 books, especially around investing, I would suggest. One is a heavy read. It is, and I think it's called Bible of the investing, which is Intelligent Investor. The second one, I think, is a very light read, which is One Upon Wall Street. It is actually far more beneficial from an observational stock picking perspective. It gives a great insight on if you are still not a financially acumen strong people, you can still look at what is happening around and you can decide on whether you want to explore more on these companies or not.
Okay, all right. I hope someone's taking note of these books. Someone send it to me as well later. I've not read a couple of them. But Harshad, what about you? A practice, something that you tell your team, in the last few years, something that's helped you, movie or, a book?
Sure. So I think on the team side, what I really focus on, so reading annual reports in the hard copy. So, that is the most important thing. So I have a team member who has Excel sheet and he has to make sure that at least 250 hard copies are placed in the office. And then for the top 100 companies, we say that you write a analysis, be it a 1-pager, half a paragraph, doesn't matter, and put it in the annual report. So we should see a page, somebody has read that annual report. So that is one thing which we religiously follow. On the book side, I think, so one book I read every year for the last few years is The Most Important Thing by Howard Marks. I think that is the book which time and again, go and revisit it, and I also have used it in my presentations. Yeah, that is it.
Well, that's such an interesting one, right? Getting that 1-pager, the team members must be nervous. They must be saying, "Aa gaya, physical copy." Kaam pe lag.
COVID made us slightly relaxed, but I think. Yeah.
All right. Saurav, what about you? Tell us that one, movies, yeah, 2 hours mein khatam hoega, but a book or a practice?
See, I think reading itself is the most important practice which every analyst, in general, everyone should, but especially if you are into investing, the reading is an ability which one needs to develop on a very religious basis. You need to read something every day. It's not, it could be a book, it could be a memo, it could be an annual report, all of this, because that reading gives you different perspectives about how others are looking at that business, how the management is looking at that business. That is something which I religiously follow, and I think I've always told my team members, and I've always seen all the legendary investors reading a lot. And I think if you ask me a book, I think one is the book which I think you just mentioned, and I think Mr. Marx had written only 2 books, and I think both of these books are like a Bible to me. Another one is that Mastering the Market Cycles. Both of these books, I think every investor across asset classes should read these. I think there are a lot of good movies as well. I'm just not figuring out the names, but...
if you do before we end this, you can let us know about that.
Definitely.
But that reading habit is extremely important, in my own way, I go live at around 7:55 a.m. on television. But I'll tell you what, 3 hours before that, I have read almost everything that I could in that morning. because my delivery needs to be a little better than it was the previous day. So reading in the morning, just make that a habit, guys. If it's a newspaper or it's, if you have access to a research report or you're on Twitter, Ajay puts out very, very good tweets, informative, particularly with regard to the globe. So reading as a habit is something that please do, irrespective of how high you grow, that reading is going to hold you and pull you through the day and pull you through life as well. Mandar, what about you? Tell us, kuch hatke bata yaar.
So, see, one is, I think Rakesh made a mention about analyzing businesses. I think that is more important. So the way our capital market function, right? There is a sell side which probably, as an analyst, you will specialize in a sector. You go in depth into a sector, and buy side will be, covering a broader spectrum. Yeah, and most of us have started as sell side analysts first and moved into the buy side. What when you are into that sector specialization, you want to understand more about the industry, and probably something which I think early in my career I should have done better is, rather than sticking to those domains, you have to wider your, the coverage and look at more sectors. Okay, not if you're covering, let's say, 4 sectors, but you should be looking at the other businesses also. And the reason is, how the cash flows matters in each of the businesses. I think, the perspective will change. And that is where I think the analysis of the different business models, will help you when the next kind of a business model is developing, right? I think that is where I think the broader approach needs to be there, and that is something, as a young finance enthusiast, I think that you should be looking at the different business models, which are there in the market. As far as books are concerned, I think one name was already taken. I think Benjamin Graham's Intelligent Investor. The other, I would say, Morgan Housel's Psychology of Money. I think the interesting part, I mean, the brilliant, the Intelligent Investor is more academically bent. Okay, so it will, sharpen some of the fundamentals of finance, for students and the investors alike. And I think the other aspect is equally important, the psychology of money, because it's more focusing about the, the behavioral aspect when it comes to investing or managing businesses. And, which both to put together, I think one academic and other is the behavioral aspect, I think should be a combination that is necessary.
Okay, all right. I think we've got a fair bit of insights from all our panelists today. Just throwing the floor open. If anyone has any question, please raise your hand. We could throw a mic across to you, and you could attack whoever you want on the stage. Yes, a couple of gentlemen. Yeah.
Good morning, everyone. My question is open to the panel as a whole. Over your years,
if you could hear your name.
My name is Saksham.
Please go ahead.
Yeah, the question is, over your years in the market, what has changed the most in how money behaves, and what has surprisingly remained the same?
Anyone wants to take that?
I think one thing which has remained common is which I think Nigel also mentioned in the beginning, markets are eventually slaves of earnings. Markets just follow earnings over longer term. You just look at any company, just take their 10-year returns and just take the 10-year earning growth. They would have always followed that. And wherever you'll see gaps in next 2-3 years, you just keep a watch. They will again revert back to that. That's a principle which has remained across markets, across market cycles, and across companies. That's something which I think has not changed, and hopefully will not change.
Earnings.
Thank you, sir. Thank you, everyone.
All right. Query out there? You can go without the mic.
Good morning, everyone. My name is Shivam. The panel discussed about the narratives like AI, defense, China plus one. You guys discuss about the fundamentals. But retail investors today move to these narratives faster than the fundamentals. So my question for the panel is, how different fund managers or portfolio managers manage narrative momentum with the long-term valuation discipline?
Interesting one. Who wants to bite that?
No, I think you are right. I think the key to a successful investor is actually to look beyond narratives, to be honest. I think narratives will pull you through in the short term, both up and down maybe. But I think on a longer term basis, as I talked about, you will have narratives, you will have management commentary. Typically, it will always be very bullish. But you have to go through business, you have to go through the business understanding, business cycle, outlook thereof, sustainability of business and growth. So all these are the key ingredients for you to make a judicious decision around investing. And there will be times, as was highlighted earlier, when there will be too much of euphoria. You probably, as a prudent investor, take a step back and realize that this is not the ground on which you want to play your match today. Maybe take a break and then come back when you see conditions to be far more favorable. As everyone has been highlighting, the key is the stock returns primarily are driven by earnings. And therefore, you have to go beyond the narrative, beyond the commentary to look at how earnings trajectory is going to be, and that is key. We also make mistakes, to be honest. I'll be very upfront with you. But the lesser mistakes you make, the better you will be.
Thank you, sir.
Shivam, I hope that answers your query. I think in short, when you're at the pitch, the ball is moving around too much. At times, retire और वापस आ जाना बाद में batting के लिए.
Thank you, sir.
Another query?
So, good morning, everybody.
Morning.
I'm Khushi. So, my question is, traditionally, diversification is based on assets. So, what is your take on the future diversification being based on factors, liquidity, and themes?
Manda?
Yeah, sure. No, I think the mantra of asset allocation remains intact. Okay, so be it less liquidity or higher liquidity. When we talk of asset allocation, we are talking about, what are the investment avenues. One is available for you, and more importantly, what you understand better, right? So, for example, if we are talking about the traditional investments, let's say bullion market, equity market, debt market, yes, real estate market, we have been doing that for years. Now, something like a crypto comes in, right? Now, how much of the understanding of the market is? Firstly, okay, so that is one. Second, is it backed by fundamentals? Okay, so that is something which is, has been under debate for a long time, right? Just because, I have, I am already invested in the traditional asset, I have some liquidity available, surplus liquidity available, let me try that. I think that will be a wrong approach. Only if you are convinced about that. I have found myself hard to get convinced about crypto market, but somebody who has a better understanding, may want to be very sure about what he is putting his money behind. And as it comes to, is it backed by fundamental reasons or is it just a FOMO? Be very fearful about the FOMO. I think that's what I'll put.
Thank you.
I think, yeah.
One
please.
more point I just want to highlight. I think on diversification, see, too much of diversification is actually not good. The optimum amount of diversification within the portfolios, I'm not talking about asset classes, because that's a burning debate throughout. If you look at it, you could actually do with a reasonably well constructed less number of stock portfolio than to have very large number of companies in the portfolio. There have been various studies which do reflect that too much of diversification is actually not a good idea. And I think I completely back what Mandar actually said. You diversify into anything where you reasonably have an understanding, or you give your money to someone who has a very good understanding. For the heck of diversification, I would advise not to do it.
Got that, Kushi?
Yes,
I
thank
think in short, from my perspective as well, when you put your money, it should make sense to you. If it doesn't make sense to you, just don't put your money. It's okay if the stock goes flying up or the asset class goes flying up. There are select assets which even Mandar mentioned. I've not participated. Maybe it went up 10 times after that. Lekin samajh mein nahi aaya, then I can't allocate my money out there. So you don't have to be part of any party. Every party. Be part of some. Have a blast at those.
Thank you so much.
Perfect way to sum it up. Thank you for this discussion. Due to the paucity of time, we won't be able to take more questions. Just to summarize really what we looked at here, we started from India's infrastructure story. Tariffs and aggressive global headwinds will definitely ping our markets, but what consensus came through was that fundamentally India stays strong, at least for the next 3 to 5 years. We see that our markets are fundamentally on the right track. Then we started talking about the parties. So how even though the globe is partying, and while it may seem that for the present moment India is meditating, India is deciding exactly which parties it wants to be a part of, right? And then there'll be cyclicality. And right now we are beating and taking up healthy corrections in the market. And what an important point that was highlighted was, while we're choosing what we want to do, it's very important to choose what we say no to and deciding what we don't want to be a part of. And of course, some great book recommendations that came through. And one thing was that credit, private capex, per capita income will ultimately drive consumption, which will increase the earnings. And what we learned is markets will work on these earnings, and that is one thing that will stay constant. No matter what you do, it's easy to get dazed in the euphoria of the market, but you need to find what makes perfect sense to you, right?
Well done.
Thank you.
I would now like to call to the stage our distinguished faculty members to present mementos to our esteemed guests as a token of our appreciation. I would like to invite Professor Sunil Parmar to kindly felicitate Mr. Ashwini Agarwal. Thank you, sir. I request Dr. Ketan Mulchandani to please felicitate Mr. Saurabh Patwa. I request Dr. Rashmi Soni ma'am to please felicitate Mr. Saurabh Patwa. Thank you, ma'am. Requesting Dr. Arun Thukral to please felicitate Mr. Rakesh Vyas. Thank you, Dr. Arun. Requesting Dr. Smita Ramakrishnan to please felicitate Mr. Mandar Pawar. Thank you, Dr. Smita. Requesting Professor Harnesh Makhija to felicitate Mr. Harsh Buravke. Thank you, sir. Requesting Professor Deepak to felicitate Mr. Nigel D'Souza. Thank you, sir. As we draw a close to the panel discussion, I would like to thank all our distinguished panelists for the insightful discussion that we had. A special thank you to the moderator. Although we will still be having discussion with you, you will be moderating the next session. Yes. Thank you so much. Students, please be seated. We are just done with the panel discussion. We will be starting with the fireside discussion. Attendance will be cross-checked by the end of the event. So only if we see a similarity with the registrations and the attendance, you will be given.
I request everyone to kindly settle down as we'll be starting with our second session right now. Now, we move on to the second session, which is the fireside chat. This discussion is intended to focus on broader themes such as investment philosophy, portfolio diversification, and long-term market thinking. So, I request all to again please refrain from asking any stock-specific queries or seeking individual investment recommendations. It is our pleasure to announce and introduce our guests for this fireside chat. First, I'd like to introduce Mr. Tushar Bora. Mr. Tushar Bora is a seasoned professional with nearly 2 decades of experience across consulting and investing, and currently serves as a partner at Invexa Capital, an SBI registered investment advisory firm. He is also the founder of MK Ventures, and prior to Invexa, he has worked across diverse roles in the investment team at Reliance Mutual Fund and in consulting roles at Accenture and TCS. At Invexa, he leads investment initiatives across sectors such as pharma and healthcare, while also overseeing portfolios spanning chemicals, auto ancillaries, technology, FMCG, consumer discretionary, and telecom. An engineer by training and an alumnus of IIM Calcutta, Mr. Tushar is also a keen writer, maintaining his own blog and authorizing a book. We are privileged to have you here, sir. Yes, sir. Now, Mr. Ajay Bagga, glad to introduce him, who's a veteran of the Indian financial services industry with over 3 decades of experience across capital markets, banking, fund management, and structured finance. He began his career at Citibank and has since held senior leadership roles at several global institutions, including Citigroup, Pioneer Funds, General Electric, Fullerton Funds of Temasek, and Deutsche Bank. Over the years, he has served as the CEO of Kotak Mahindra Asset Management and Lotus India Asset Management, and as the country head and managing director of Deutsche Bank India's Private Wealth Management Division. Today, he is an active private investor, serves on multiple boards, and is a widely recognized voice in financial media. He has preponed his flights and travel schedule to join us, especially for our event. So, sir, we are beyond grateful for your presence in this event.
Thank you.
We will now start the fireside chat.
Okay, thanks a lot for that. Well, just before we start this fireside chat, I just wanted to tell you all something about both the panelists. So, when I've been in the industry for around 15 years ballpark, and when I started getting a little active on Twitter, Ajay sir used to reply, and he used to reply very positively. And that positive impact, helped me build onto that, onto the Twitter platform and other platforms as well. So always grateful when you have a positive comment that comes in, it's always good. And Tushar, obviously he's got various cycles, made very, very good investments, has a great career. But I have spoken to Tushar at 11:30 p.m. in the night. I've spoken to him at 12 midnight also. We don't meet very often. We're meeting actually after a while. But in time of need, I've messaged Tushar, yeah, I want to understand this. And at that time, we had met maybe just a couple of times. But still he'll entertain. He'll tell me from grassroots, particularly a couple of his core, businesses that he understands. He'll make it very, very simple, pharma, APIs, And I've also taken the leverage in my life to even introduce my wife to Tushar. So she also calls up and asks, Tushar, ye samjha do. And he does it. So, you know, in certain times of your life, everyone doesn't need to like you. Few people like you, it's more than enough. It gives you that good feeling and it takes you through as well, you know, in times that matters the most. So thanks a lot, gentlemen, and good to have both of you all on the panel itself. Let's start off first with the top down. No one knows what Trump's going to do next, but Ajay, I see you write a lot about globe, about geopolitics as well. What is your take first with regard to how the entire global environment is shaping up? At one side, you have these US markets that are doing well. Most global equities have done well. Equities as an asset class seems to be looking through any kind of negative, whether it's geopolitics, whether you look at the debt to GDP ratios globally as well. And everything is like that chalta hai attitude. What is your view first with regard to the geopolitical scenario right now?
Thanks, Nigel, and thanks for that introduction. As everybody does these days, I asked ChatGPT to make my speech for the day. So it said, tell this Gen Z that you have a very bright future, full of opportunities. So I said, okay, what do I do next? And it sent me a link to LinkedIn Premium to look for a job. So I said, nay. And third, I said, I've got Nigel as the moderator. So it said that your IQ is half of Nigel. We would suggest you don't go. He wears different colored socks also. So he's a fashionista, drives the latest bikes, goes on great holidays, which your wife compliments him. So ChatGPT, as all of you, I know you also consult ChatGPT for your classes, was telling me not to come here between Tushar and Nigel, but I followed. I knew he would be kind to an older man. So the world is changing. That is very clear. The old order is going. And the diplomatic core in the world are not ready. Even including our foreign service, they don't understand. Nobody can deal with Trump because his strategy is strategic ambiguity. You create uncertainty to such an extent that everybody's trying to figure out. Sometimes what he's saying he will do, most of the times he won't do. So first we thought his negotiation style is going to be give a very outlandish demand and then negotiate downwards from that. But the way they picked up the Venezuela president, he's actually done it. So that has changed things a lot. Very difficult to forecast because the best guys can't do it. So in that kind of a scenario, we come back to the fundamentals. That gives you some amount of mooring. We have to understand US is the biggest economy, it's the biggest military, and it has a president who's willing to leverage that military. It wants to undo what has happened to the world since 2000 when China was let into the WTO. It's not an easy job. I don't think it can be done anymore. That train has left the station. What do? We have to engage. We can't say that we will keep doing better even if there is no US trade deal. We've got a New Zealand trade deal or we have got XYZ. Now we are talking about EU trade deal, which is very good. But we need to have that trade deal. And I keep saying that we need to take the risk. You have seen with Tesla, Nigel, 227 Teslas got sold. Harley Davidson came in, hardly any Harleys got sold. Only very, real, you can say the connoisseurs picked up in Harley. Otherwise, our Bullets and our Royal Enfields are very good. We have driven them all our lives. So I think we made too much of a fetish of this. Russian oil again, now the message is sinking in that maybe we were too much in saying about energy security, this, that. Look at the Europeans. They've quietly done it. The exports from Europe to Kazakhstan, Tajikistan, Uzbekistan have gone up 1,000% in the last 3 years. It's not that more population has come. The money is, the goods are going to Kazakhstan and going to Russia, money is coming back. They've quietly done it. We have worn it on our shoulders saying it's our energy security, this, that, should have done better. Will it get sorted? As you said in the previous segment, I don't know. But we need to sort it out. So I would say Trump is not a cause, he's a symptom. Even when Trump retires, there will be a Trump 2, there will be a Trump 3. It's not going to change. The world order is changing. China +1, I don't think we will catch that bus. We will not be the factory of the world, so we have to find our own business model. China, what it allows us to do, they will allow. Right now, $100 billion of trade deficit we are running. We are taking the goods from them, adding 20% value and sending, and we are very happy that these billions of smartphones we are sending, 80% of that is Chinese inputs into it. So learn to see that, and once you see that, then you realize it's still work in progress. We will have to figure out our model.
Okay, interesting out there. I think Trump took offense, right? Everyone started talking about taco, that he always chickens out. He said, no, I'm not going to chicken out. I'm going to do actually what I say. So we have tariffs at 50%. You have him pick up a Venezuela head over there. Maybe the Cuba head is next. We don't know what he's going to do with Iran. But hopefully better sense prevails out there. But Tushar, I want, you've been bottoms up. And you've picked a lot of stocks. So let's start off with the basics. When you're looking at a stock, what are the top few things that you look at? What stands out for you that you say, okay, this is something worth studying, and then you get a little bit deeper?
Interesting question to start. I'll try to link it back to the theme, which is cycles, right? And flows. So I think in today's world, everything is cyclical. Whether it is perspectives, whether it is perception, whether it is performance, or whether it is prices. The one thing that's not cyclical is people. So if you understand the DNA of the entrepreneur, if you are able to get that right, I think not much else will matter. Because to be frank, let's take a real example, solar industry, right? Solar has been the sunrise industry, so-called, since I think 2010 or 11. When the first solar plants were coming up, I think 16, 17 rupees a unit. And the prices were on one way, down. The module prices, cell prices, everything was coming down. I did this analysis 2016. We looked at 55, 56 companies, listed, unlisted, everything, right? NTPC of the world, Vikram Solar, Vari, and this and that. At that point, nothing seemed really investable from a theme perspective. Until 2020, 21, nothing. And then all of a sudden, in 3 years, just look at how solar has, come to dominate the mind share. So we did a private investment in Vari sometime in early 2022, and the kind of run up that the stock has seen, backed by performance, if I may add, in just the last 3.5 years. So Vari is an example, and I'm not going to give any specific companies from a future perspective. These are all examples from a point in time in the past to highlight learnings. But if you see, the companies like Vari are example of survivors in a cutthroat industry, in a difficult industry at a difficult time. They've spent many, many years struggling and staying afloat to have their moment in the sun. So if you only come to look at it today and just look at the last 3 or 4 earnings, you'll see, a lot of, it's like a celebrity, right? You see the celebrity status, you see the fame, you see the aura. What you don't see is the years of struggle behind it when nobody was looking at them. There are a lot of companies like that. So what you really need to look at is, you first need to get the entrepreneur right. Then you also need to understand the opportunity size. You cannot have a top class entrepreneur, looking at a very, very small opportunity and leader in a very, very small niche. In fact, a lot of good companies begin in small niches, but it is the ability to move beyond that niche that will define the entrepreneur's journey and also your investment outcomes. See these, the metrics that we study in college, or if you do a CFA, you'll have DCF, models, you'll have ROE, ROC, price to earnings, and so on and so forth. And when you actually go out there and you try to apply that, you'll be stumped. It's like a full toss, you try to hit for a 6 and you get bowled instead. Because, markets don't behave on theory. Markets behave on behavior of not one individual but a group of people. So you also need to understand the behavioral trends, but new people make the same old mistakes and market teaches them. And that's when, things move a full circle and come back to the basics. So I don't know if I'm making sense here, but it's like driving, right? You learn driving and you really rigorously understand the basics कि कब accelerator दबाना है, कब आपको clutch करके gear change करना है, and the basics need to be ingrained in you. And when you're driving on a daily basis, you don't tell yourself that. But when you are, driving at 180 on an empty road, it should be ingrained in your mind that even a slight, curve of the steering can be hazardous for you. So that basics have to be ingrained back of your mind. It's not something you'll remind yourself every 5 minutes or in our world every single day. It is something you will keep coming back to. Markets will teach people a lesson and you will come back to the basics. But to briefly answer the point, we look at the entrepreneur, we look at the passion of the entrepreneur, how true he is to the business, how well he understands the opportunity, how well he understands the landscape. Then obviously we're looking at what the opportunity size is, what the industry is. Most important is whether the person has a right to win. And he understands it and he has been able to build a business and process around it. If these things are there in place, I think a lot of the fundamentals will eventually come into place. And one most important word which is today, more for the books and the masses, which is ESG, which actually matters is how the person behaves with his employees, with his colleagues, with his board, with his stakeholders, and really whether governance is just a buzzword or actually practiced in the company. And I could give you off the line real examples, real companies that have got listed, billions of dollars, raised billions of dollars market cap, and the promoters have absolute pathetic attitude towards their own employees. And we've seen it in meetings. And we've switched off at that point. Because whatever else you say doesn't matter.
Okay, important points out there. The promoter intent, the industry tailwind, and the right to win as well. Just to push you a little bit on that. Sometimes when it doesn't add up, you want to give us an instance? When, for example, we hear about the story is that you went to an office which was newly done up just to raise that capital. And actually the cups were as clean as ever, the laptops were not started ever, it was set up for that fundraise meeting. Give us a couple of instances, Tushar. I'm sure there are many.
Yeah, so actually, I'll give you an example of this one. I don't want to come to the specific company. Let me give you an example of one of the investments which has done well for us, which is Laurus Laboratories. I think it is very, very difficult to predict business momentum and business cycles. In such times, again, the basics help. We did a large investment in Laurus. We were one of the participants in a block where Warburg was the seller. And I still remember a couple of WhatsApp groups, people were laughing, Warburg is selling, and so we were one of the buyers, and people had their way of saying a joke, okay, so you know more than a guy who's been in the company for 10 years or close to that time. And Laurus did 3x in the next 1 month. 3x. I'm not sure how much Warburg made, and obviously it's a great institution. But that is how, what markets teach you every day. But what really matters is that to take Laurus as an example. See, you have to understand the promoter's passion. It runs for decades. It's not a passion that is going to look at this quarter and the previous quarter and the next quarter. In fact, when promoters start talking too much about individual quarters, it's probably the time that you should run away from those talks. You look at Laurus, one single thing stands out in every conversation. And I think that they are a bit more optimistic probably than they should be. Reality catches up sometimes. But very, very passionate, very single-minded focus. Has a 5-year, 10-year vision of what he's doing. And when promoters execute like that, they are not worried about... So to actually take, their profit in 2019 was 90 crores. And they had a lot of capacity which was just set up, which was not earning anything. In fact, it was a drag on the business because the costs start as soon as the capacity is up. In fact, sometimes even before the capacity is fully up. But the profits obviously take time. The utilization takes time to ramp up. And in 2 years, between FY19 and FY21, the profits went from 90 crore to 900 crore in just 2 years. So that obviously you can't model for these kind of numbers. You have to understand the business, understand the promoter, and take a leap of faith. The other interesting thing is that 3 years, 4 years thereafter, The profits have struggled to, keep up in, so obviously they haven't grown at that pace. In fact, they're still at that same level. Does that mean that it was a flash in the pan? No. Because over the last decade, those guys have generated more than 5,000 crores of free cash and invested more than 7,000 crores. So effectively, they've stretched the balance sheet despite generating healthy cash. All of that money is going into something that they are building as a vision for maybe next 5, 10, 15 years. If you don't understand that and you only look at the balance sheet and you only look at, the profit is not growing and the balance sheet is expanding and there's a lot of debt on the books and the promoter holding is low, once you start to look at it only from, textbook theory, you will miss the point. The point is that a guy has started in an industry which was already competitive, well established, come from the behind, really created a stellar business in a very short span, and is continuing to invest. He doesn't bother what you think or what the textbooks say. What he's worried about is where he will be in 2030 or maybe 2035. And what most of us are worried is what the quarter four earnings will be.
Very, very good point out there. I've had the privilege of interviewing Loris Laboratories a few times. And, obviously there were various investors like Tushar and the fund that were in. And it went through many quarters actually of disappointment, of not delivering the numbers. And Dr. Chava, but will it be better the next quarter? Because that was what my interview is about, right? How was the past quarter and what is the near-term impact? But as Tushar says, sometimes stocks like these, they test your patience and you have to be in for the longer runway. And if I'm not mistaken, Tushar could correct me, the stock spent, I think, more than, 1.5 to 2 years in that vicinity of around 300 to around 450 rupees. And once it took off, once the numbers came, it is a 900 rupee stock, the last stage, like 900 or 1,000 rupees or thereabouts. So that's back yourself, it tests your patience, and then in fact, the returns are there in some of these cases. A past example is what we're using. But Ajay, coming back to you, given the uncertainty that we talk about in the globe, and we have this trade deal, you have earnings, you have central banks that are doing a jig of their own. People out here would like to understand asset allocation is important. How much money to put in equity as of now? Give and take everything. Take the risk on board as well. How much into equity? How much into gold and silver? We could term it as precious metals and maybe break it up into debt.
See, Nigel, it's like going to a doctor and saying, what medicine should I take? So we will need to know your risk appetite, your time horizon. And
we're looking at a longer time horizon.
Longer time horizon, youngsters here. I think you should, as a youngster, starting off career, next year all of you will be starting your jobs. You should be 100% equity. I think if somebody had told us in the 90s, it would be very different. And within equity, I would add on the fundamental change that has happened in gold and silver. Last Sunday, I was at a conference in Jaipur with the Bullion Dealers Association, and I was moderating for a change. And I asked them that, how do you see gold and silver? All the knowledgeable guys are saying, I don't know. But silver, what I do know, he's saying 6,000 tons Indians brought in last year. 1,000 ton we ate up or put for God on the sweets. So we are putting 1,000 ton of silver on sweets and offering it to gods. He said, why don't you stop eating silver and investing in it? That was what Mr. Prithviraj Kothari was saying. So I think gold and silver, some fundamentals have changed. You all know it. You can also check it out on your generative AIs, what has changed. But what Tushar mentioned on solar, for example, again, downstream you go, you do need silver. Moment you see an EV car, you know this is silver. Moment you see AI, moment you see data centers, it's the silver story. So I think 15% in my heydays, we would never allow, I have done a financial plan for 27 out of the top 100 Indian houses. Personally, I have done in my heydays. We would not allow more than 5% in precious. But what I am seeing now, whoever comes to just discuss informally with me, about 15% is what ultra HNIs are now running in gold and silver. Is it famous last words? All the bullion guys said, yes, it goes down for a number of years. Is it happening this year? Nobody has a clue, Nigel. So I would say, because there are so many trends backing gold, especially central banks are buying about 1,000 ton every year of gold. And that will continue, that de-dollarization, the debasement trade, all that is going to continue. So 15%, out of that breakup, 5% gold, 10 silver. Because silver is gold on steroids when there is a bull market in precious. So silver outperforms very massively. And 85 equity for all of you here. For someone my age who can't regenerate capital, I'm about 45-50% in equity, but I have some very good other high risk investments which I do. So I'm okay. Last year, again, it's all my money, so I am not allowed to tell you, but I was very happy with the returns. Again, the gold and silver helped, and that I just stumbled into. I never believed in gold and silver because I got all the cycles wrong in that. And it will come to that. Someday it will fall off, maybe a couple of years from now. Already, if you see the cost of solar panels, the solar erection is going high because of the silver cost. So people will look for alternatives. Right now, that's the purest conductor available. It's not very easy, but something will come. Intensity of silver has gone down in solar.
Okay, interesting. So 15% in precious metals. Just one more asset I want to ask you, Bitcoin, did finance mention anywhere or stayed away from it?
No, youngsters and the people who knew have made a lot of money in Bitcoins, but far and few people have really made money. Again, you have to know what to get into rather than the meme coins or the ones which are being pumped. Those have really gone down over the last 2 years. Bitcoin has a view, and the others also, a few of the top ones, where institutional activity, Nigel, is coming in. So you have institution, now State Street has just announced. So do track that, maybe 2%, not more than that.
You know, and just to tell our young audience out here with regard to silver, silver hit $50 an ounce many times, but it couldn't get past that. 1981, if I remember correctly, the Hunt brothers, there was, silver was at $50 an ounce. Today it is $90 an ounce. In 1981, way before a lot of your parents got married or even were courting. So, that far behind. Then in 1990s, it hit $50 an ounce yet again. And people said, this one's going to go through the roof. It didn't happen. And 2011 as well, it again hit $50 an ounce and it didn't go up. This time, however, what I understand, and going by, Ajay is talking about a higher allocation to silver, is because this time the fundamentals as well seem to be backing it, because it's industrial use and it's precious metal use as well. So that $50 an ounce, once it broke past that around 3.5 months ago, quickly it's moved to around $90 an ounce, because now it's having a bit of a breakout moment. So let's see where it goes from here, but a lot of wise minds say it will not be now a percentage move. It could be a multiplier move from here. So let's see whether or not that happens. So just some insight with regard to silver. It hit thrice $50 an ounce, couldn't get past that. Today it's at $90 an ounce. And another barometer that you normally look at is silver to gold ratio. Around a year ago, silver to gold was approximately 95, 97 times. That's come down to around 75 times today. So there is a bit of an adjustment. Price of silver to gold. But Tushar, coming...
Just two more, since
Please.
you went into details. S&P to silver, we have not even started. So that is coming. And I've changed my steel kada to a silver kada, which is already up 3 times in the last 1 year.
Lovely. I think I need to change mine as well. All right. Tushar, coming across to you. We'll get back to the good times and, obviously good investments. But some of these stocks, either they make you money or they teach you that lesson that you'll never forget. Tell us one such instance, when something hasn't really played out, where you thought there was value and you backed yourself, but ultimately there's some time when you have to say, I think I'm going wrong on this. It may be a value trap. How do you distinguish between that value and that value trap?
Before I come to answering your question, I have to make this remark. Sorry, sir, but आपका जो कड़ा है, essentially अपना लक पहन के चलो. So he started wearing it, and silver prices have just not stopped one way. So maybe it's you coming over to this side of the camp. On a more serious note, see, And I'll address your question, but I know you won't give me a chance to do a lot of macro stuff, so I'll take this opportunity myself. Please. But see, asset allocation, is something again that, there's a theoretical concept. How much should be debt, how much should be, liquid investments, how much should go to real estate, gold, and so on. And then there's a practical learning. Now, a lot of the people of, let's say, your parents, for example, right? A lot of them would have made tons of money in real estate. And no matter what you teach them about equity, they will not switch, right? A lot of you will end up making unbelievable amount of money in bitcoins or maybe whatever is the next, big asset class. And anything that I say to convince you or Ajay says to convince you about equity, you will not listen. So eventually, rather than trying to model your portfolio on a theoretical construct, you should experiment. And in the previous panel, someone said, so I think Mandi aa gayi. Sir. So in the previous panel, someone said about Bitcoin that you will not touch it. I would say, why not? It's about experimenting. It's about trying new things. If something is rising up as an asset class, you should give it some time, and it wouldn't hurt for you to give it some money. The question is how much time and how much money, and that is an individual's decision, an individual's discretion, because someone who's dedicated their life to Bitcoin is probably retired by the age of 30, 35, whereas we are still slogging. So there is no right answer. Please don't go by a theoretical concept of asset allocation. I'll give you two light-hearted examples, real anecdotes. My wife's portfolio has significantly outperformed mine because she only invests in gold and silver. She's been doing that for many years. And every time I look up stocks and we discuss portfolios, she has a smile on her face, and I have medicines close by. So it is how life is, right? There is no right answer, but you need to understand that asset classes move in cycles, and a lot of these asset classes move counter-cyclically. So when equities are not doing well, typically commodities, metals, gold, silver likely to do much better, right? There will be a time when real estate probably will do much better than the other two. So you need to understand why asset allocation is important, more from a inflation hedge as well as a counter-cyclical investment strategy. Also, one very, very important part of every portfolio is cash, which is not talked about. Because in times like these, the ones who really will move ahead are the ones who actually have cash to invest. We don't know whether the correction, broader market correction will last for next 3 months or next 3 years. But if you have cash today and if you end up deploying in this correction phase, you probably end up making a lot more money. If you ask anyone who started investing just before COVID or just after the COVID cycle, a lot of these guys have made unbelievable amount of money in just 3-4 years. So it is important to understand the role of cash in portfolio and asset allocation more as a practical subject, not as a theoretical study. And now coming back to the question that you said.
Just to finish that point with regard to this asset allocations, and do what, consume all the data points and then do what you think is best, as Tushar said. Me, for one, most of my money goes into equity, but I still will not miss on that PF, PPF, Sukanya Samriddhi, NPS. What dalega? Let it be that, it is that tension-free, risk-free, interest, whatever. There's no worry on that front. And if I'm getting a lower return, that's my loss. But at least I'm assured of that small return. But please go ahead.
So now from a learning perspective, I'll tell you about my two of my investments, which have been very, very high conviction investments, which have both done very well. And in both, I have a regret. Well, we shouldn't have regrets as investors, but we do.
Got out early. Got out early.
One I got out too early and the other I stayed on too late. So
let's hear both of them.
Yeah. So one of the first stocks that I really did work on when I joined Madhu at Nippon was CCL Products. Fantastic company, great promoter. I don't think they've diluted after the first fundraise in the last more than 20 years. They haven't diluted equity again, or at least till the last time I checked. Fantastic company, right? And we had 10% of CCL products in one of the fund schemes. And one of the first tasks Madhu and Sunil gave me when I joined them was that have a look at this stock. The company has not really gone anywhere in the last few months, couple of years that we've been holding on. Excellent promoter, stock has not done well, and we were inclined to sell. But since it's a large position from a company perspective, 10% of the firm, of the company we were holding. So they asked me to do some work, and without getting into the specifics, we didn't sell at that point. We sold 1.5 years later, an average of 8-9x from there, right? And in my personal, investing book, I had the option to take approval and actually invest in CCL. I ended up not doing it, because equity as a work, you're playing a role of an analyst, so काम पे जा रहे हो, ideas देना है, is different from personal book. Personal book की understanding नहीं थी, तब भी नहीं थी, and I'm still learning, right? So I ended up not investing, right? We sold at around 200, 250 range. We sold off, and then stock did nothing for 3-4 years. Today it is close to 1,000 rupees. In just over a decade, maybe 12 years, the stock is up more than 50x from the point at which I first looked at it. And while as a fund we made a lot of money, and obviously I owe my career in investing to CCL. But personally, had I just invested what was still a very reasonable amount back then in my personal book, 50x on that amount today, it's a lot of money. The second is one of my top convictions was Tata Elxsi. Still a great company. I still like the longer term prospects. But that is where cycles come into understanding, actual real learning. I first, so my dad had invested in Tata Elxsi sometime in 2009-10 in that vintage. Very, very small position. He was not really a major equity investor, but he had invested a small amount in Tata Elxsi, and then it had a few years of dull period. He was not really making any money, and then 2014 I think is the first time stock went above his price, and he asked me casually what should I do about it, and I told him sell it off. इतने साल से आप होल्ड कर रहे हो, क्या आपका पैसा कुछ बना नहीं है, ये वो small position है, sell it off, and he sold it off for a small profit. And then some few months after that, I ended up actually studying the company, which I should have done earlier. I didn't. And I realized that it was a gold mine at that stage. You look at 2016-17 vintage. ER&D as a theme was just picking up the entire shift from automotive mechanical components to the software and technology ecosystem. Very interesting stage of the company. One of my top convictions. In fact, I used to have this thesis that every analyst on street is looking at for the next 2 quarters and is looking at a 25-30% CAGR. You should just look at a 6% hurdle rate, because that is what your deposit hurdle rate, and look at a 20-year cycle for this firm. And you should just keep investing in an SIP mode. And that worked beautifully for many years. But I continued to pitch, or rather be bullish about Tata Elxsi well into, it was 30, 40, 50 bagger from the original levels. And I continue to be bullish about it. And markets teach you a lesson when you think you know it all, right? When you have a very high conviction on something, markets teach you a lesson. So in the last 3-4 years, if you see, the stock has gone nowhere. The earnings have gone nowhere, right? And if you held on through that phase, there are other areas of our portfolio that have gone up 10x. So that conviction has actually hurt me, because if I had looked at it more rationally, I would have probably realized that the stock was pricing in many, many years of growth ahead. And the time to sell, it was not a time to buy more, but a time to sell at that point. Probably a time to buy will emerge at some point. But that is very important to understand, that prices also have cycles, multiples change. So what looks cheap at 60-70 multiple today, we saw someone say Staples 50-60 multiple. Tomorrow at 30 multiple or 25 multiple, that will look expensive. In this same market today, SME and mid-cap people are bashing left, right and center. A lot of those stocks are available at single-digit trailing PE multiples. Nobody wants to buy. So rather than try to, again, time and again, एक single lesson मैं आपको देता हूँ. Don't look at investing or life theoretically. have a practical understanding and awareness about the subject. That is going to be more important than anything else. There are 8,000 listed stocks. You need only 10 in your portfolio. No matter where, what is happening geopolitically, macro, what is happening, कल कुछ भी हो जाए जाके, अगर आप markets में हो और आप 10 stock identify नहीं कर सकते हो, which have a longer term, view, fundamentally positive view, and your benchmark is not the best in class performance. Your benchmark is what your money would do otherwise, which is probably debt or FD. So get the right benchmark, have the right view, identify 10, 15 good stocks, do your own reading, and spend more time reading and learning rather than watching the ticker.
Okay.
Sorry, it was a very, very long response.
No, got that. 10 stocks, 5 Shankar will give in the next panel, and then we can get the remaining from you guys. Ajay, what about you? Tell us about that big call that you made, at some part of your career. As you said, you have managed money for many of the top, corporates, institutions as well. And something that worked, and it was an outlandish call at that point of time. So if you could jog your memory and tell us that something that stands out, either that worked or didn't work.
I think the biggest thing that we lost out on was 2008, and I was in the US, met a lot of hedge fund guys who were talking about what was happening, and things were getting worse and worse. And I remember Nagnath of Merrill and I were discussing, and his global CEO was visiting. We met him, and he was saying these mortgages are not looking good. But I didn't wake up. And 2008 January, what Sensex was, it took till 2013. Yes. So I think that was one very big miss for all portfolios. And unfortunately, our company was owned by Temasek, and we used to say proudly, these are billions of dollars and they will never disinvest in India. And they made so much losses on their global portfolios that they pulled out of. And what got sold for 5,000 crores a few years later, I sold for 1 rupee at that time. So that's the lesson life teaches you, and you go on with it. I think that miss was personally very costly for me, not getting out at that time. And just now, Shankar made a lot of money in Amazon, and I was quite surprised in your talk. I would like to hear your thoughts. But Saks just went for bankruptcy, and last year they were already very leveraged, and then Neiman Marcus they bought by taking more leverage, and guess who funded them? Amazon put 450 million or 475 million on a very leveraged balance sheet where they were taking more debt just to pay salaries. So again, I'm saying, don't blame yourself, no regrets. The best of the corporates make such moves. The sovereign wealth funds in 2008 were all in the red, and they made these scuttling moves of getting out of India at that time. And they lost a lot of money, left a lot of money on the table. So that, what has worked? Lots has worked. Shankar and I were in Citibank together. We were very lucky. We got options on what became Oracle India, Oracle Finance. And just by sheer inertia, because I had those physical shares and getting them dematted, it stayed. People sold at 400, 800. Somebody bought a Jolly Maker flat. Just kept holding it. And that 8,000 rupees today gives a 25 lakh dividend every year. And it's not any stock picking or it's just sheer laziness, and the stock worked out. So lot of stories. If you are old enough, you have at least 20, 30 such stories in your portfolio, because we have seen what were DFIs becoming banks, what were housing companies spawning banks, and just because they were colleagues who joined them and they said just invest, or all these software companies we have seen at ground zero. I'll give you one anecdote. Unfortunately, it's being recorded. Okay. I'll take out the names, but one very...
fine. Disclosures are good. Past instances.
You don't talk bad about people.
Oh, okay.
So it was a well-known company at that time, And another very big company today, top 3, was going for IPO, and we were scouting how to get money into them. And this gentleman put some, whatever he had in his account, 1 lakh rupees or something. And that company no longer exists, the one who invested. And his investment in this top 3 company is worth like, 2,000, 3,000 times, and much more than what his company was at the peak. Just that small investment, whatever he had. So these opportunities do come. My generation, Nigel, were very lucky. I saw maybe a 2000x on my salary, starting salary to the last salary I drew, and I retired in my mid-40s. So I lost a lot of my peak years, but that's the kind of money our generation made. The market itself, it's a theoretical, you can say 7,900 Sensex, but let's take it at 100 just for making the point. 2006, the market was 100x. So if you were born in the right time and you invested in the right time, as my friend Shankar Sharma did, the market gave you 100 times, he made 1,000 times, but that was the thing. That was, the luck of India, luck of the draw. If you were born in India and you started working at that time. Now I think these MBAs, you are the first AI generation, and it's different, but maybe some other time we'll talk about that.
So 2000x the salary went up, is it? Yeah. Wow, that's lucky.
We were underpaid.
Nigel is calculating the 2000x on his first salary.
No, I'm just thinking, No, I'm actually, in fact, I've got a story since you all mentioned 2008, and Ajay referred to Shankar as well. So a friend of mine, Bindu Benjamin, she used to work for Shankar back then, and Shankar didn't call me for the interview, so I was like, okay, but Bindu got in. So, the entire gang, we were on Kashid Beach. I'll tell you the date as well, since you all referred to, the peak of the Nifty was on 21st of January, 2008, 6,300 mota. And in September 2013, we had 6,300 again. I remember that. Here's where luck plays a role. We were on Kashid Beach, drinking some good beers, having an easy time. And my dad was investing in an apartment in Bandra. He's falling a little short in money. And he had all the, Sri Renuka and, various other stocks at that time. And he was saying, I'm going to go, I have to take a personal loan, it's not happening and all. So I said, Pops, do one thing, sell everything. So January first week, D'Souza Khandan from Bandra is all out, okay? And the house is in, okay? Papa thought that I was like a fund manager, because the next few years, it's like, my son, he sold these shares and all. So just pure luck made me feel like 2000x salary or whatever, because the house was in, the shares were out, and for the first time, Papa said that you have done something good, man. So that was 2008. I remember those dates as well. But Tushar, coming back to you, since we spoke about some of those past instances, a couple of investments that you all have made, the transformers and rectifiers space. You all were one of the lone ones in there who got positive on that space. You all rode the entire cycle. Now again, it's in a bit of a tizzy, the entire sector on the whole. Tell us about a couple of those investment theses, either transformers and rectifiers. I recall Tilak Nagar as well, when they had that big debt in their books. These stocks are already up 10 times, from those depressed levels, 2021 odd. But what was the thought process? What was the thesis you all went in? Because at that time, it was ignored. A couple of these examples were absolutely ignored, which the street gradually got positive on.
So, since you're getting to closer to where we are today, right? Obviously, don't want to get too specific on some of these names. And I just realized that we are being recorded. So, yeah. So, but I'll tell you one thing. See, if you
let's make it easier, right? Let's talk about a theme.
Yeah, I'll address both these examples rather than getting specific on them. The thought process, which is the important thing, right? So, see, when you're in a thematic tailwind, right, and the company has capability, and it is going through a bad time, typically a lot of these turnarounds, if you get it right, you make a lot of money much faster than what you would assume you would. So, let's take Trill, right? So, they had a bit of a stretch on the balance sheet. power has been in a thematic tailwind for some time now, right? At least last 3-4 years, we very clearly have been talking about the need for power, and the power requirements will only go up materially from here also over the next 5, 7, 10 years, with the kind of the data consumption that we have, with the kind of gadget requirements we have, with the need to grow, with the need to be more efficient and so on, more performance oriented in everything. Power requirements are only going to go up. And a lot of India still doesn't have access to full power, unrestricted power 24/7. So there's a long way to go. But this specific company that we're talking about, they had a bit of a stretch on the balance sheet, and not many people were willing to look at it at that stage. Just to explain how things turn behaviorally, right? So let's say when you're in a bad time, your main client, will know that you're in a stress, and you depend a lot on him. So the payments will come later than usual. The margin will be squeezed, right? And you have nowhere to go. You need capital to grow. You need working capital to grow. But if that capital is not available, you will end up being stuck in what is definitely a average contract. The moment you have fresh capital, your client suddenly realizes that you have now options to choose. You can let go of this business, wait for some time, take something at a better margin. So suddenly the payments will start to come much faster. They will realize that they were squeezing you, so the margins will improve slightly. You'll still say कि नहीं यार छोड़ो तुम्हारे साथ में मैं 100% commitment नहीं रखता हूँ. I'll find 2-3 more clients who will give me a better, more stable business at better margins. So suddenly, and you have the capability already. Suddenly you'll be able to get better quality business with better working capital terms and better margins. And what was a stretched balance sheet and a very average P&L, suddenly both will start to look better. And what was a bad time and bad multiples, suddenly the times are improving, so the multiples will also improve. So it sets, one small action sets into motion a virtuous cycle where everything is improving. You're getting more business, you're getting better quality business, your balance sheet is improving, your cash flow situation is improving, more investors are willing to talk to you, better quality investors are willing to talk to you. People see that, so obviously more and more retail HNA guys, more PMSs will invest. And before you know it, the multiples which were, so you have what I say, good things come together, bad things likewise. So you have bad times, bad multiples, good times, extraordinary multiples. So this cycle, if you are able to identify a thematic tailwind, identify a good company which is stressed in that situation, and where you think that the fundamentals of the business are not broken, you can make a lot of money very quickly. And that is something that we endeavor to, sort of like a template, trying to keep fine. Obviously, we get it right a few times, we've suffered a few times. But in the end, I think it's been worth it.
Indeed. Ajay, just a couple of closing comments then from you. Frothiness. Everyone talks about the froth after it's already in. How do you identify something like that when the market's getting too euphoric, too frothy? What are those indicators? Maybe cash flows didn't come about, the company never paid dividend, the promoter kept diluting equity, something like that, that particularly stands out, which says, okay, this is the red flag, time to be cautious.
Yeah, what you mentioned, overstretched valuations, over-leveraged, very easy. I'll give you one example, one story to just make it simple. There's this very good friend of mine, hedge fund manager, comes on CNBC a lot. And we had a family wedding, and he was there, and he said, just talk to my son, and so I met this youngster, 3 years out of MIT, 1 year in Google, 2 years his own company. And I had a good chat, and how are you doing, and how are you looking? And thank God, somebody came and whispered that this is the company. And I realized his stake that day was worth $8 billion. So then I said, can I do a job with you, managing your money? 23-year-old company got a 29 billion valuation. So, but they have revenues. This company has revenues, unlike a lot. So that you will see. In fact, Ruchir Sharma's note on the over exuberance I had posted the summary and Shankar took me to task on Twitter that, these points don't make sense. So we look forward to the real classic bear to tell us. But, you know it when you feel that, when you see things around. I don't think we are there. Indian market, last 2 years, we have just been marking time. And September 2024 levels we saw, and then we came down again. So we've had time to catch up. But what it's really showing is that much more reforms are needed. A much lower tax rate is needed. A lower interest rate is needed. The freebies that are coming into the system are really very dangerous, I think, and it's K-shaped. So there are the top 1% who are French per capita, the top 5% who are Eastern European, and 80% is sub-Saharan. That is the risk, I think. So it's not all very hunky-dory. That I'm saying because he's sitting here, and I'm always trying to please him. But 80% sub-Saharan, hey, you just go little bit out. You will not believe 100 kilometers out of Bombay, you have hamlets where electricity or water has not reached. So we are missing that point in all this consumption, all that. And government doesn't have the money at 12% tax to GDP. The government just doesn't have the money. It has to be private enterprise. For that, you have to just unleash reforms. You have to open it up, which nobody is willing to. So we are caught in a classical thing.
Shankar taking to task on Twitter is तो known यार, नया क्या है उसपे? It's known.
तो मुझे नहीं करता, वो पुराने ज़माने के लिए वो बहुत regard रखते हैं, but
is he used to it now? Never. All right, Tushar, closing comments then. Red flags. Talking about the good times is very good. But identification of those red flags are extremely important because, as I always say, this market makes you a lot of money, or it teaches a lesson that you'll never ever forget. So, identification of red flags.
First and foremost, beware of smooth talkers. I'm not talking about you, Nigel. But beware of smooth talkers. See, you have to understand that if someone gives you grand vision and there's not enough depth behind it, probably that vision will fall flat. Also, it's important to actually meet people extensively. Like Nigel said, do a lot of factory visits. Some of you will get that opportunity. Be more aware about the realities on ground. One very good way I have of trying to differentiate, let's say, both good companies and bad companies from the average is you just look at the financial metrics and the performance metrics very closely. You look at the averages for the industry. Typically, both the leaders and the laggards will show deviation from the average on the key variables, right? And intuition generally will let you know whether that deviation is from a leader's perspective or from a badly run company's perspective, right? So let's say, just as an example, if I'll give you an example of a chemical company, which I will not name for obvious reasons, but it was supposed to be a specialty chemical company, right? And when you say specialty chemical, the mind is that it's a high value addition company, right? And their gross margin was 30%. So 68, 69% or almost 70% of the cost is raw material. So there's hardly any value addition. When you say specialty and a commodity chemical company is at similar gross margin levels, then the starting point is wrong. Then every other cost in that company, the employee cost, manufacturing cost and everything else wound up in another 2% of revenue. So what is a 32% gross margin is a 30% EBITDA or 29% EBITDA company. And if you just look at, at random you select 5-6 chemical companies, whether it's commodity, specialty, whatever. If you look at 5 or 6 well-known, reasonable scale companies, and you look at their average employee cost, average manufacturing cost, average OPEX, and you look at this company, you will know that there is something is not adding up, right? And I had to spend a lot of time with that promoter to understand the business and this and that. Spend a few hours to understand. And I entered the meeting knowing that this is probably going to be an average company because I had seen some of this stuff. I came out of the meeting convinced that it is indeed an average company. Because the promoter is an excellent salesman, the numbers just don't add up. So what I will say is that read balance sheets, read annual reports, but more importantly, don't look at an individual company. Because if you start with the lowest company in a sector, you'll have an excellent annual report, then you move 2 notches up, you'll have an even better one, 2 notches up, you'll have an excellent annual report, and so on. So don't read in silos. Look at the averages for an industry, for a segment very closely. Try to correlate the commentary with the numbers and look for deviations.
All right, well said, and thanks a lot for that example as well. Very, very, good when you put an example on board. Well, thanks a lot, Tushar as well as Ajay. I think it was a fun chat with lots to learn, and the good times, the bad, everything's part of the journey, right, ultimately. So I hope you all enjoyed it as much as me, and get ready, Shankar's next.
Great learnings from this session. We ultimately go back to the fact that we are going back to our basics, the people, and we also explored the fact that maybe the spike in silver might have been caused by Mr. Ajay's backing after switching his steel kada to silver. We now move on to the felicitation.
I would now like to call to the stage our distinguished faculty members to present mementos to our esteemed guest as a token of our appreciation. I would like to invite Dr. Smita Ramakrishnan to felicitate Mr. Tushar Bora. Thank you, ma'am. I request Dr. Raghu Kumari ma'am to please felicitate Mr. Ajay Bakka. Thank you, ma'am. A very big thank you to Nigel. Thank you for moderating both the sessions. And thank you, sir, for joining us at such a short notice. Managing Director of First Global, a globally recognized institutional research and brokerage firm serving clients across India, the US, Europe, and other emerging markets. At First Global, he also leads the Global Strategy Group. Frequently featured across leading global financial platforms, he is widely known for his insights into market cycles, macro trends, and portfolio strategy. Today, we look forward to hearing this perspective on market dynamics and the evolving investment landscape. We welcome you, sir. To moderate the one-on-one discussion, we have Dr. Hitesh Punjabi. He is a professor with Department of Finance, KJ Somaiya Institute of Management, Mumbai. He has done PhD in finance, MBA in finance, BE chemical, chartered market technician, member of CMT Academica Committee, and alumnus of IIM Indore. He is a SEBI registered research analyst and has over 20 years of experience in industry and management education. Dr. Hitesh has contributed articles and has published research papers in national and international journals. His areas of expertise are financial markets, security analysis, portfolio management, equity research, fundamental analysis, technical analysis, mutual funds, behavioral finance, and many more. Thank you, sir, for joining us.
Thank you.
We will now start our one-on-one discussion.
Good afternoon. So today we have a veteran in front of us.
Thank God you're not calling me a bear.
I was thinking to call a bear or a bull, but
a hare.
A hare, the better. Sir, you have spent so many cycles over the years. Can you just take us through your journey of investments for the young investors here sitting over here? From the start of...
So as my dear old friend Ajay said, that I think we were a blessed generation. And if you read the book Outliers, it's a very interesting book in which he traces that, like for example, US tech titans, they were all born within like a couple of years of each other. I'm talking the previous generation, not the current ones. And because they entered their best years when the US tech boom in the early 70s was just starting, you just kind of just had to show up in, of course, in that area. If you were in Minneapolis, you were not going to get it. But if you're in Silicon Valley or around that area, you just had to show up. And that is pretty much our story as people who are in their early 60s or late 50s, that we entered our prime earning years in our mid-20s and onwards, just when India, first of all, went through a crisis in 91. But crisis is the time when usually we do stuff to solve it and then to move forward. And we just got purely lucky, to be honest with you, in that sense that the timing, in hindsight, was just pure fortune. Nobody could have predicted that we would have had to, mortgage our gold. And thereafter, because of that, we liberalized. We went from a socialistic mindset to a more capitalistic setup. All of that is hard to say that कि यार मैंने सब कुछ देखा था. सब कुछ नहीं था, because we were in Citibank, and as Ajay was saying, 2000x. So I have not calculated, but मेरी तनख्वाह when I joined, I remember in the investment bank was 4,000 rupees a month, and we were all grossly underpaid in hindsight. It was pure exploitation. आजकल जो गिग वर्कर्स के ऊपर जो चर्चा हो रही है वो हम भी वो इन दैट कैटेगरी थे. सिटी बैंक न्यू दैट दीज बगर्स हैव नोवेयर टू गो बट टू अस, एंड दे एक्सप्लॉइटेड अस रूथलेसली. Of course, they gave us a nice, chamri and all that in Bombay or Delhi, whatever. But fact is that I remember when I decided to leave Citi. I decided to leave Citibank on my third or fourth day of being in the merchant bank. Because I said, yaar, it doesn't look like a great life to me to take companies public and promoter itna paisa banata hai and all that. And we are just going to get a piddling little amount by way of fees. And we are literally not in the ring. We are sitting actually outside the ring. And I made a decision, and our common friend Naganath, I remember. So I used to stay in Bandra, and Naganath had his chamari just behind us. And Naganath, of course, a very, very dear friend, continues to be. And we had a little, chai session in my chamari. And I said, yaar, main to chhod raha hu, I'm leaving. And there were a bunch of us from the investment bank there. And he said, कि क्या पागल हो गया कि सिटी बैंक कौन छोड़ता है and all that. I said, यार boss, I'm done. मैं तो ऐसे ही छोड़ देना चाहिए था 88 में, but it's never too late. So he said that कि why? I said, look, I'm making some 2,000-3,000 rupees a month after tax and everything. And of course, we had a car loan also. So because 2% में मिलता था, तो all of us bought cars and all that. And I said, यार इसमें तो कुछ आनी जानी है नहीं, month end में पैसे नहीं होते हैं. And I was actually in a taxi at in around those times, and I asked the taxi driver in Bombay near Churchgate कि यार तू कितना बनाता दिन में? बोला सर 100 रुपया मैं कमा लेता हूँ. तो मैं बोला यार हम लोग MBA करके और साला सूट पहन के ये करके करा के मुश्किल से करते हैं, ये बंदा चप्पल में बैठा हुआ है and he's making 3K. I said okay, this is now my benchmark. कि I am quitting if I don't make that much as much as a taxi driver, then लानत है अपनी डिग्री पे, एजुकेशन पे, सब बकवास है, वेस्ट ऑफ टाइम है. And that was the reason why I actually quit, apart from the fact that I remember distinctly that little tea party that I had with Naganath and a couple of other people. I said, यार मुझे लगता है कि India is literally at the cusp of a big stock market revolution. I just had this like a complete clarity, I don't know why or how. I said, year 2000 mein we will be like a significant stock market, boss. Back then the market was already significant in Asian context, but I said, यार ये globally हम लोग कोई जगह बनेगी इंडिया की. And I want to be in the ring. Literally in the ring means the Bombay Stock Exchange ring, playing the game rather than just watching the game pass me by. And I was, I think, 26 or 27 at that time. And they said, you're true. And I spoke to a couple of seniors also, not for advice, but just to sound them off. They said, no, you're too young, you don't understand this game. You know, thoda time lagao, spend some more time, understand what market is. You just entered, you know, merchant banking. And merchant banking and stock markets are all very obviously the same ecosystem. I said, yaar, dekho, aaj main agar chhodta hu na, I'm a nobody. Nobody knows me. So I have no ego. रोड पे सोना होगा सो जाऊंगा, कोई प्रॉब्लम नहीं है. बट आफ्टर 5 years 7 years VP बन जाऊंगा. सिटी बैंक में अपना नेचुरल प्रोग्रेशन 7-8 साल में लोग बन ही जाते थे. तो उसके बाद आप मुझे अच्छे अपार्टमेंट दे दोगे इन कफ परेड, एंड देन आई हैव अ बॉम्बे जिम मेंबरशिप. I said, it's not going to be possible to quit. It's impossible. I will never be able to leave that exit, you know, crossing that exit barrier. So I made a lot of those calculations that, yeah, there's nothing to lose literally. And
the risk return was favorable.
Exactly. 3,000 रुपये ही तो था ना, बेंचमार्क इतना लो रखा था. मैं बोला यार चलो इसको तो क्रॉस कर ही लेंगे. And then the rest is, of course, we got lucky. 1990s revolution happened. India became a really growth economy. From the Hindu rate of growth, we became like a 6-7-8% growing economy. And in that sense, as I just said, we have been a lucky and a privileged generation. You know, I don't want to sound like a damn cloth, but journey from here on is going to be incrementally more difficult simply because of the size effect that at 4 trillion to match those growth rates is not possible. I mean, I think the total GDP, if I remember correctly, was $50 billion end of the 80s. 200-300 था मेरे ख्याल से 2000 में. So, I mean, like every company that grows to a size, they cannot, like Infosys of the world, they cannot match those growth rates even if there are no other problems, simply the size has become so much. So therefore, the opportunities on a macro basis in India might be more limited than on the micro basis. So the complexion of investing game, you know, has changed and will continue to change. But yeah, I mean, you know, I really can't complain.
How do you identify the pitches quite so early? I mean, I wonder, like a Sachin Tendulkar, you play across the world. Your portfolio, I'm sure you have made huge amount of money in US, Latin America, and India. But how do you decide the pitch?
See, that again is a matter of, again, a journey. So I remember in 97, 98 in the Asian crisis. So we were doing fantastically well. FIIs were coming in. We were making a lot of money on the brokerage part. Back then, I remember, it sounds like a fantasy. 1% brokerage milta tha on fairly good size. And we were making money hand over fist, and then the Asian crisis happened. And I remember speaking to, you know, my partner Devina, and I said, "Yaar, ye crisis mein," and we were obviously traveling to Hong Kong and Singapore and all these countries to pitch India. मैंने कहा यार वो countries इतनी हम समझते थे, flashy, beautiful roads, good infrastructure, अगर वो डूब सकती तो हमारा तो यार तो कहीं भी मतलब there is no bottom to this country, and especially 91 was a very fresh memory. You know, in our minds. And as an anecdote, in 91 crisis, so there was this very known corporate law Companies Act expert called Dr. M.C. Bhandari. His was the tome that was there on every banker's thing. Now, we used to meet him for some IPO advice in Citibank. But as it turned out, he was also a very good astrologer. Okay? Not from this thing, he would read your aura or face or anything. He was decently good, actually, to be honest with you. In fact, when he met Devina the first time, he told her that you're going to leave Citibank very soon. And she left after like a few months when the Bombay Stock Exchange membership came. And then both of us met and he said, कि यार, you don't have to worry, you're going to be very, very rich. तो मैंने कहा चलो sorted है life यार, मतलब भंडारी जी ने बोल दिया. But I was not even asking कि आप बताओ क्या future and all that, but I asked him specifically in 91 crisis. I remember he had a suite in Taj. I said, sir, देश का क्या हुआ ये बताओ, हमारा future तो we are embedded ना under the future of the country. And it was a very scary moment. So that scary moment persists when you live through a crisis like that. And in 97, 98, when Asia went through a similar situation, I said, yaar, this is too risky as a business for us to be 100% in India, all eggs in the Indian basket. And of course, we are Indian, we will remain Indian. But the investing part doesn't have to remain Indian. Money and your country love cannot be merged. They're two separate things altogether. And that's when we decided strategically, let's diversify abroad. Also that the scale of opportunities, obviously, when you go to a market like US is far more. Obviously, it has more challenges. Companies are more complicated. But we made a decision. We went to RBI, got our permissions, remitted capital, set up subsidiaries, got memberships of the London Stock Exchange, NASDAQ and everything. Put up like 40, 50 member analyst teams to understand companies from Japan all the way to the US, with Europe. That was rewarding beyond the money it made. It was simply, it opened your mind to a size and scale of companies we were not used to seeing in India. I mean, Sun Microsystems, I think, I remember, uska to balance sheet ही कुछ पता नहीं 500 पेज का था या कुछ था, and it had some 100 subsidiaries. And यार ये समझेंगे कैसे हम लोग अभी भी? Because in India there were, subsidiarization of Indian companies were not that in vogue back then. So it was single company, एक दो division, 4 division होंगे. It was super easy. So, but the point I always say is that you should look for stressors. Don't get into comfort zones. Build a stress so that the body and the mind can adapt to the new challenges and the new stress. That's why you go to a gym. That's why you do intermittent fasting. All these things are stressors on the body, and of course the mind is an adaptive organism. It will adapt. So वो challenge डाला तो अब उस वक्त जब करना स्टार्ट किया लगा यार इतनी economies है, इतनी moving parts है, कैसे समझेंगे कैसे? It was like a huge ocean, and barring Bloomberg there was hardly any internet there also. But the point is, we threw ourselves a challenge, self-created. There was no reason to do that. So to answer your question, that was, today I find it really a piece of cake, and I don't want to sound arrogant, but to understand the globe and all the moving parts, the foundational part was just making the decision. Once you made the decision to understand very complicated things, the rest followed. You will build your systems, you will build the teams, you will build the processes. And as a result, today I find it super easy. I mean, like last year, the 25 that finished, this has been, actually speaking, the least work I have done on stock market. The least in my whole life. The least. And I'm sure, Ajay knows, I mean, I travel, I take like, at least, my minimum rule is 10 दिन महीने में मुझे छुट्टी मनानी है. 10 days, minimum. ज़्यादा भी हो गया, but I think December and January was a little bit much, थोड़ा ज़्यादा हो गया. But spending that little time and still making decent money, I think that is the holy grail, but that holy grail comes only when you've made the hard yards, done the hard yards 25, 27 years back. So stock market is at one level very simple, but at another level is very complex. You should get rid of the simple if you want to play across all areas of the game, meaning T20, ODIs, Test cricket. That's why we regard Sachin, right? All formats.
All formats.
That's why Virat will never be Sachin. He's got a limited areas of I'm sorry if they are Virat fans, but it's a fact, and I think he's a great player, but obviously he's been found wanting in the 5-day formats. But Sachin is Sachin because he has played every single format in every single country and done it with aplomb. If you put your goals at that level, you will adapt to reach those goals. Maybe वहाँ नहीं पहुँचोगे, उसका 50% ही पहुँचे. That's good enough.
Sir, we keep hearing in every cycles of markets, this time is something new.
This time it's different.
Is this a dangerous statement?
Yeah, so we
Every
know
time
it's
this time
different,
is
but
something new.
we know this is a very old saying in the market,
Yes.
obviously, this time it's different. And we always think कि पहले different था, but इस बार, you know, it is going to be a continuation of the status quo ante. But होता नहीं है, things are different. Things will change, you know, markets change, complexion change. And which is why I say that I'm not a bull or a bear, I'm a hare. I'm prepared to change my mind very quickly. And I prefer to be more flexible rather than have a very straight-jacketed perspective about markets or investing. Because, I mean, gold and silver is now being talked about, and we see on Twitter and all graphs that Nifty ko beat kiya gold and, but that is all recency. It was not the case, let's say 5 years back, correct? But if you saw that coming through whatever systems and processes you did or you had, you have adapted to a newer reality which is not visible today, but वो थोड़ी दूर पे वो नजर आता है. And even if you take small positions which you can build later, you are automatically better than the street. Because street is still playing yesterday's game, while you have changed your game a little bit.
Position sizing.
Which is position sizing, but first of all identifying कि यार आज का game कल नहीं होगा. The pitch will change, conditions will change. So that is really, to my mind, you know, something I have inculcated in myself to remain super flexible, and
That is very important.
Not to have a fixed point of view about markets or, for that matter, anything.
Sir, you talked about gold and silver. That's a burning question which everybody has here. What next? Where are we in the cycle, commodity cycle as of now?
No, so I've been bullish on both of these, apart from a few others. But again, that's a cycle. In 2003 to 7 bull market also, we saw, you know, gold, which was, I think, $200, $250, went to $800, $850. But on the other hand, and this is something that I think I've talked about or written about also, when my father died in 81, I remember after cremating him, you know, just a day or two later, you know, I asked my mother that what do we have? Because I was just out of school at that time. And she said, ki, beta, I think SBI branch, we have some fixed deposit or something, main branch, you go there. So I went there, met the bank manager. He said, ki, haan, there are a few lakh rupees and all that. But I suggest you take out this money and put it into gold. He was a good guy. And so I came back and I said, okay, done. So then we broke the FDs and bought gold and all that. And gold did not deliver, I think, to the best of my memory, even fixed deposit returns for the next 15, 20 years, till the 2003 bull market started. 85, 86 का peak तो वो जाके 2004 में take out किया. So today you are talking about it because it's been in a bull market last 2-3 years. तो वो recency है, अभी वो चल रहा है, कल को कुछ और आएगा. But I think so far as I can see, and our common friend Samir is fond of saying that nobody knows anything beyond a point, but that is also a fact. I mean, that also shows that you are humble enough to know कि यार मैं इतना line of sight clear नहीं है मेरा. It's a good perspective to have, and which is and I completely echo that. कि अभी ठीक है, I think for the foreseeable future, and I never look 1 year के आगे. That's not in my nature to predict things beyond 1 year. Nobody can, and nobody even should try to. Filhal, it looks good. The factors look good. But we'll see. We'll keep agile. We'll keep open-minded about making U-turns as and when necessary.
10% of a portfolio is sufficient? Gold exposure in the current environment?
I mean, that's a boilerplate advice. I don't want to get into that. But I think it's a good thing to, in any case, as Indians, we have always had that much and more, far more than 10% on an aggregate nationwide basis. But if you're an investor, I think that's a very wise thing to do as we speak right now.
Okay. Yeah. Coming with respect to small gaps.
Right.
Which has been the major bumper ride for last year for all the investors in India specific. They have not been performing, portfolios are down, people are entering to mid caps, small caps, and they're bleeding like anything. And what next? Is the small cap index?
Market में एक ही rule है, sir. What gives you maximum pleasure will give you maximum pain. This is what I believe in firmly.
Perfect.
तो आपको बहुत सुख दिया, अब ये दुख देगा. अब point is at which point you decide कि बहुत सुख हो गया, अब ये दुख के दिन आने वाले हैं. That is the trick.
Or how do you decide, how do you identify a red flag, a small, of a
रेड
small
फ्लैग
cap
देखने जाओगे तो
to-
कोई भी स्मॉल कैप नहीं लोगे, ये भी बोल देता हूँ बॉस. I mean, if as I was talking to one auditor who's experienced guy many years back, and he said, sir, अगर आप forensic करोगे ना, दुनिया की कोई कंपनी दे दो, मैं आपको 500 रेड फ्लैग दिखा दूंगा. So इसका मतलब क्या है, कोई शेयर ही नहीं लोगे क्या? It's like कि आप ब्लड टेस्ट कराओगे या कोई टेस्ट कराओगे तो कुछ ना कुछ तो आएगा ही ना. ऐसा परफेक्ट रिपोर्ट तो शायद ही किसी का आता होगा. डॉक्टर का खुद कराओगे तो उसका ही आधे पैरामीटर्स खराब आएंगे, राइट? So the point is that small caps will have a lot of risk attached to that. We all understand that. The problem is we kind of again forget that they are part of a cycle.
Yes.
Everything is a cycle, and this is something I understood that 25 years ago in the dot-com boom and bust. That when a certain class delivers returns which are 2 or 3x of its long-term returns, in most cases that's pretty much the top of that asset. And before this, Tushar was talking about exiting too early and all that. There are metrics I use to, even at a stock level, you can use a lot of data to understand at which point it's good enough to take money off the table. It's not that difficult. Rule of thumb, okay, subject to exceptions, is if any stock, okay, so let's back up. The best performing stocks over 25, 30 years, globally or in India, most of them cluster around 25% CAGR. Okay, कोई 28 दे देगा, 30 दे देगा, but the best ones will be around 25, 27, 28% over a very long period of time. Now, if you know that data and your stock or your bunch of stocks is doing 75% CAGR, okay, first of all, वहीं पर मालूम है कि इस long term ये भगवान की कंपनी भी होगी, it will revert to a 25%. It might revert to a much lower number, but वहाँ तो आएगा ही आएगा. But you can say 25%, 75% in what period? Okay, can it be in 2 years? No. Again, stock cycles will typically follow market cycles. With a bit of lead and lags, that's a different point. I don't want to finesse it too much. But if your portfolio or your stock has delivered 2x of its relevant index over a 5-year period, okay, so let's say small cap index, dekh lo, 5 saal ka return I think is about 40-42% from say COVID levels, correct? If your stocks are doing 2x of that, or let's say 3x of that, so between 80% to 120% CAGR over a 4 to 5 year period, you have to and you must take money off the table. Because statistically, it is impossible that that will give you the same compounding. It will give you some compounding, but can it keep up at those breakneck speeds? Unlikely. And in doing so, what you will do, you will free up capital, wherein the lake of returns theory, which I thought of back 25 years ago.
I was coming to that lake of theory.
And it works for me. I mean, it may not work for everybody, or there are nuances and finesses to that. But on a broad basis, whether at the market level, whether at asset class level, or at a stock level, I use that, and I'm prepared to be wrong 10-20% of the time, wo hoga hi hoga. But bulk of your gains you can lock in using pure data points of how much returns the market has delivered versus how much this stock or this industry has delivered. And 2x or 3x of that over a period of roughly 4 to 5 years or 6 years, you are pretty much at the full level of the lake. Us time mein, you should lighten up.
For the audience, make sure you read through a lake theory. It is available on the net, refer to it. The sir has worked on this in an excellent way and explained excellent way. Please read through it at a later stage.
It was, I mean, for example, you know, in India itself, 2024 was the peak of the market. It was amply clear that the remainder of the decade will not match the returns that we have seen in the preceding 4-5 years. It was not difficult. Now 2 years have passed. We have, in dollar terms, we are down 10%. I don't see that changing dramatically. It might rally, which it will. Everything will rally at some point. But whether you will match the returns of 2020 to 24, 25, very, very unlikely. Because the lake of returns of India and the returns it delivered were 2x or 2.5x. So, wo full ho gaya. Now the emptying has started. You can do reforms, you can do whatever you want. but cycle is supreme.
So 26 is a wipeout year again?
I don't think it's a wipeout year. There are many stocks which are going to do well. But the thing between a bull market and a bear market, and let's not mince words, we are in a bear market. It's not an absolute terms bear market, meaning the market you can say at the surface is still flat for 2 years. But the median market is down substantially.
Yes.
More importantly, relative to the world, we are in a bear market.
Yes.
If you see our performance versus practically any other benchmark, I think we are down 30%, something like that. So we are a relative bear market. We are in a bear market. In a bear market, what happens is the range of opportunities that do well shrinks to maybe 20% of the universe, maybe 10%. In a bull market, that is 80%. इतनी सी ही बात है बस मोटा मोटी आप देखो तो बेयर मार्केट में आपको से 100 कंपनीज है आपको 10-20 ही अच्छी मिलेगी बुल मार्केट में 70-80 अच्छी मिलेंगी वी आर इन दैट फेज वेयर it's going to be much harder to make substantial returns simply because the cycle is not favorable.
What about an IPO?
No,
IPO market is booming.
IPO is a rigged game, boss. I mean, you cannot make money buying. I mean, odd company here and there, you can say, I bought it in IPO and you made money. But on a broad basis, IPOs are, and especially today's IPOs, are stacked against you as an investor. I mean, everybody understands that. Because, the IPOs, first of all, because of venture, I mean, and this is something I've said this, written about it, that, see, every stock has a finite period of excess returns. There's nothing called an infinite period of infinite excess. ऐसा है ही नहीं दुनिया में कोई कंपनी नहीं हुई है अब मान लीजिए आपकी जर्नी 2 फुट की है from 0 to that 100. The best companies in the world that we know of, okay, are defined by only one parameter. एक ही parameter है, which is the CAGR of the life of the company. उसी पर होता है कि ये कंपनी बहुत अच्छी है, ये कंपनी बहुत फालतू है. Now, if you think about it, all the great companies of the world, so India में आप HDFC Bank, Infosys ले लो, Bharti ले लो, Reliance ही ले लो, all these we say great because they have delivered great returns over a long period of time. अगर returns नहीं आ रहे हैं, promoter is very good, Inayan Murthy is pure as driven snow and governance है, लेकिन अगर भाव नहीं चल रहा है तो सर हमको कोई interest नहीं है उन सब चीज़ों में. Same way Microsoft, Apple, even Tesla's, Google, they are all great companies because they have delivered great returns. Okay, but the great return part, वो कहाँ से आता है? Only one metric decides that. How early you go to the IPO market. Because your range of money making years, best money making years is
bounded.
Is bounded. उसके ऊपर में it will degrade. There is something called return decay, which again, this is my way of looking at it, but returns will decay over a period of time. So best period में अगर VC funding आपको मिल गई या PE funding मिल गई तो आपकी जो ये 2 फुट की जर्नी है उसमें आपकी IPO आ रही है 1.5-2 फुट पे तो आपने तो कुछ छोड़ा ही नहीं ना एक्सेस रिटर्न का जो पीरियड था वो तो ये खा गया करेक्ट दोज ग्रेट कंपनी नेवर हैड VC मनी दे नेवर हैड PE मनी दे हैड ओनली IPO मनी so they went to the markets early. So if you look at Bharti, you look at Infosys, you look at Microsoft, Apple,
Amazon.
Microsoft में क्या था 85-86 में ही पैदाइश हुई थी and उसी के 1-2 साल में हो गया था. Amazon itself,
Amazon also.
I think 94-95 company, 96-97 IPO. So VCs have distorted the return spectrum of the market and therefore the IPOs which come out more often than not are VC funded IPOs, especially the more popularly known ones. The returns have already been eaten away. आपके लिए कुछ छूटता ही नहीं है. अच्छा प्रमोटर जो वहाँ पर होता है उसके बाद 5% 7% होता है. He doesn't call the shots. It's more the VCs who are sitting on the board and deciding on the pricing and largely offer for sale होता है. अब वही बात है इतनी अच्छी कंपनी तो ऑफर फॉर सेल कर क्यों रहे हो यार?
क्यों निकल रहे हो?
क्यों निकल रहे हो बॉस? क्यों निकल रहे हो? So it's very axiomatic that IPOs, especially in the IPOs markets or that we know now in the last 4-5 years, will never make you money. It's impossible. Aggregate पे नहीं बनेगा आपका. But I don't know why people still end up subscribing so much. I mean, that is another question to which I don't have an answer.
Because every day in my class also people ask, should we subscribe to this an IPO? I said IPO is the most dangerous thing to apply. Rather go to secondary markets. That's a better way. You have
या
time and tested it.
या उसी का वेट कर लो यार. और स्टैटिस्टिकली 70-80% विल ट्रेड बिलो द आईपीओ प्राइस. उस वक्त खरीद लेना. अभी अर्बन कंपनी मुझे अच्छा लगता है, लेकिन अब वो 160-70 जहाँ भी हुआ था, अब 125-30 पे ही तो है. वहाँ खरीद लो ना. वो जो मैनिक्योरिस्ट पेडिक्योरिस्ट मसाजिस्ट हो तो साला 125 पे भी काम करता है और 150 पे भी काम करता है यार. बट उसको इतना भाव भी क्यों देने का. मिलता है. आई एम सेइंग एक दो छूट जाएंगे, बट अगेन इन इन्वेस्टिंग रिमेंबर वन थिंग, एंड इज वेरी इंपॉर्टेंट. देयर इज नथिंग कॉल्ड परफेक्शन. देयर इज नथिंग कॉल्ड परफेक्शन. परफेक्ट इज द एनिमी ऑफ द गुड. That is something I firmly believe in. That you look for perfection, you will end up getting disappointed with even good. I remember in school I bought 2 lottery tickets, and this is actually a fact. एक 5 crore का लिया था और एक 50 lakh का लिया था. Now in that journey to the जब निकलना था, I used to walk around and think यार साला 5 crore रुपए आ जाएगा मेरे को, तो मैं क्या क्या करूँगा. तो ये करूँगा, वो करूँगा, फलाना को ठिकाना करूँगा, ये करूँगा. ये यहाँ तक कि I anchored my by desires to 5 crores कि अगर 50 लाख आता, मुझे लगता क्या यार साला मतलब लॉस हो गया बॉस, मतलब 4.5 करोड़ का. बिकॉज आई वॉज सो एंकर टू अ परफेक्ट आउटकम. अब 50 लाख रुपया स्कूल में, जहाँ पर कि इंडिया तो 70s मतलब 5-25 लोगों के पास ही होगा पूरे देश में. सो विद यू शूट फॉर परफेक्शन, यू आर गोइंग टू डिसरिगार्ड और डेनिग्रेट गुड. So don't shoot for perfection. IPO मार्केट में हो सकता है एक दो आपने छोड़ा जो बहुत अच्छा किया, but statistically most of them will trade below IPO price. It's a fact. कुछ टाइम दे दो उसको, बहुत अच्छी कंपनी है, give it some time. You will get it below 70-80% of the time. That's good enough.
Any sectors in your mind going forward, looking forward, which are upcoming sectors?
So my view is very clear that if you look at the best markets, let's say last year, the best markets were markets that had a lot of tech or a lot of commodities. अब commodities तो हम पैदा कर नहीं सकते. We have some commodities, but not super blessed in terms of many commodities. But tech पैदा कर सकते हैं, जो हमारे यहाँ नहीं है. And tech as a percentage of market cap today is next to nothing. If you see pure tech. I remember in 97, 98, 99, something like that, I asked my economist कि यार मेरे को बताओ कि इंडिया का GDP का क्या percentage है at the pie chart. So he said 55-60%, 50% was services, बाकी manufacturing, agriculture. Then I said कि निफ्टी का निकालो या सेंसेक्स जो भी था. That time it was, I'm talking more like mid-90s. I remember around 95, 96. It was 70-80% was manufacturing. Services were hardly any. HDFC Bank had just listed. I said, yaar, how can there be such a big disconnect between the pie chart of the country GDP and the pie chart of the market? Simple one-line analysis tha. And I remember with this theme, we did a lot of business with the FI. I went and said, ki yaar, India will become a dominant services market cap versus a dominant manufacturing market cap. And aaj aap dekho, so manufacturing is hardly any part of the market. Even of the profit pie, I think manufacturing may not be more than 20%. 70-80% of the services ka contribution hai. I'm saying the same metric if you apply on a tech basis. The world is awash in tech. That is the way of the future. We don't have any. That market cap has to rise. But that tech, if you think buying IPO of so-called tech company, wo nahi banega. For that, you need to go out, meet companies one by one, maybe buy them at the unlisted stage. That is going to be a hard one to do, but that is where the big rewards will lie, in my view.
That is quite a difficult job to.
Very difficult.
Very difficult.
No, and the very high failure rate. Tech में बहुत high failure होता है. You don't know कि वो tech कितना durable है, कोई और आ जाएगा. With all of that being said, I think still that is the area. At least I am putting money there. And I'm prepared to lose 20-30% of the time. वो तो जाएगा ही जाएगा. But on the once I will win big time.
Sir, you have been quite a good aggressive learner over a period of time, what I have been observing. You have adopted AI quite well in your firm also.
Yes.
I read about it. You have launched a product which is helping you for investment analysis.
Yes.
Can you just put some light?
Yeah, so, I mean, because I do a lot of global, and there are the pieces of information are very distributed and disparate. So I asked my AI guys, and our AI business is basically a business in which we make AI applications and softwares for a variety of companies across the world. It's not only finance-centric, it's also for industrials and like in the Middle East, we are doing something for a big fertilizer company. So I said, yeah, कि मुझे एक tool बना के दो with these requirements in which I can get instantly what's going on in the world in a very easy to digest format. And that's how FinXray, which is the product that my team created, but they did it for me. वो मेरे लिए ही था. And then I gave it to a few friends कि देखो देखो, and people liked it. ऐसे कि ठीक है यार, दे दो, दुनिया को दे दो, कुछ तो साला पुण्य कमाए हम लोग. आज तो पैसे तो भगवान की दया से आ गए, thanks to the timing more than anything else. And I mean, now we have tens of thousands of users, mostly very, very satisfied, very happy. I feel that at least that's my way of, and it's nothing, almost free or next to 200 rupee and all that, which is nothing. I just think that's a good tool, and we'll add on to it, we'll improve it. Of course, that's an endless journey. But it has made my investment become so simplified. Because see, ultimately, a very complex world needs to be simplified. Yes. The tools will help you do that. This tool, I built it with my thinking. I said, if it works for me, so hopefully it will work for a larger body of people. And usually the best products come when you do it something for yourself, because you built it, purpose built for your own thinking, and then I've expanded it to the world, and it's actually very rewarding. We get a lot of comments, a lot of messages, that I found it useful.
Students, you can subscribe to the same. It is available on the service website.
Yeah, it's there. You can just Google it, you'll find it. But yeah, I mean, that's in a way my way of at least giving people a broader perspective in a very easy to understand, actionable format. That's pretty much what it is.
So all the metrics,
it has a lot of stuff, but it's very easy to understand. I mean, for example, just looking at that, flipping through that, I found Colombia is a great trade. Year and a half back. Now, if I'm not mistaken, Colombia was like, I think, up 30-40% last year. अभी 200 रुपए का सब्सक्रिप्शन है, तो मतलब वो तो फ्री हो गया ना. So at least to know दुनिया में क्या हो रहा है, because one problem, and I say this, and thankfully Nigel is not here.
Yeah.
Oh, you're here.
He's there.
Okay. Is that our media is too centered only on India, and there is a good reason, because the market is in India. But ultimately, people will need to go outside of India to make serious money. There are no two ways about it. India is our backyard, we understand it. But the wider perspective is very, very essential. My product at least gives me that perspective, and through me, it gives it to a wider. क्या भाई कोलंबिया तो किसी को भी नहीं मालूम है कि मार्केट है भी वहाँ पर. We always thought it was Pablo Escobar. But there is stuff happening there. There are companies there, there are people there. Or for example, copper trade. Abhi copper I have been long. But through
India,
copper,
we have no choice. There's no ETF.
Yes, यहाँ नहीं है क्या मेरे को? I thought copper was traded here, no?
No, it's on MCX, that's all.
है.
Or maybe Hindustan Copper. I think that's the only option.
That's not a pure play.
That's not a pure.
So through that, I got Chile as a trade, because if you like copper, then the next logical thing is कि भाई copper का जो producer है वो कौन है? Now Chile is obviously a big producer of copper. तो वहाँ से Chile का trade निकला. Chile has done phenomenally well last year, like a absolute. So that way LATAM निकल गया. अब LATAM आपको वैसे बैठे हुए नाइजल कभी नहीं दिखाएगा आपको. नहीं दिखाएगा. लेकिन LATAM has been a standout, blowout, bunch of markets, which the FinXray gives me. तो at least मैं दे ही दूँ, आपको dashboard दे दूँ, तो rest is pressing a button ना.
Got it? You got the tip how to identify the stocks, screening. Okay. Before we wind up, I think I have a big list of questions, but due to constraint, I'll have to put it across to the last one question.
कोई दिक्कत नहीं.
Sir, if you are mentoring one of these students here, what would you advise them?
बहुत simple है. Please don't think of investing as a game of deterministic outcomes. It is a game of probability at the end of the day. Let nobody tell you any other thing. This is my only learning in 35 years. Ki boss, it is ultimately a game of bets. If you start thinking in terms of bets, your mind will be always very clear. Ki bet hi to hai. And I was, on the way here, Shlok, I think, the guy who works with me here, he was here. And, we have a lot of investments in Indian companies. And हम यही बात कर रहे थे कि हम किसी भी कंपनी में बुलिश नहीं है यार. हमको तो सब में ही डर लगता रहता है कि साला ये करेगा कि नहीं करेगा, क्या होगा नहीं करेगा. In fact, Tushar spoke about high conviction. I have a little different point of view that I find that a very dangerous perspective to have. Because high conviction eventually means high ego. Because मैं convinced हूँ इसका तो ये मतलब नहीं है ना कि actually speaking वो conviction justified है और बाजार को भी convince होगा नहीं होगा. So I prefer to be a little bit more scared rather than be very convinced about an idea. Even a company in which I own 7%, 8%, which you were discussing, and I met the promoter a few days back. मैं बोला यार लगता तो है लेकिन भगवान जाने साला करेगा क्या आगे जाके. तो थोड़ा डर के रहो. Understand it's a game of probability. And if you want to play the probability well, and this is very important, central learning is that you have to create a wider opportunity set for the probability to work in your favor. Simple as that. So the wider your catchment, which is why going global helped me, that my catchment widened dramatically. Okay, because India my catchment was more limited. Globally catchment became big and it continues to help me today. Like for example, Colombia, otherwise catchment में आता ही नहीं है तो आप miss ही कर जाओगे. Widen your catchment as much as possible. Only then the probability will work in your favor. I mean it's simple ना. अगर आप 5 बार toss of coin करते हो, तो your outcomes will be let's say 2, 3 heads or tails. यही होगा. 5 love होना impossible है. But the moment you go to 100 tosses of coin, you will average out at 50-50. More or less, 48-52 or 49-51. But मोटा average आपका 50-50 पे आ जाएगा. If you run at that average in investing, you are making money hand over fist. I mean, there is no question you will make a ton of money. But in order to do that, your catchment has to be 100. And frankly, most people think that you got this stock or Rakesh got that stock or XYZ. But that was not the only stock he bought. That's not the only stock anybody bought. It is only in hindsight we know that out of your 50, 80 bets or 100 bets you took in a life, 2, 3 will be out of the park hits which will cover up for a lot of your other mistakes and sins. But if you look at Picasso, and I was reading somewhere, he made 12,000 paintings in his life. Shakespeare wrote hundreds of plays. आप जानते कितने हो? 20-25 तो जानते हो ना? तो आपको भी you have to do 12,000 paintings. उसमें से 25-50 आपके super hit होंगे. But if you think you're going to make only 12 paintings and all of them are going to be hit, it's not going to happen. So start thinking only in terms of bets. It's a probabilistic game at the end of it, no matter what you're taught by professors. But you can make the probability game work for you rather than against you. So the less the number of bets you take, the more random the outcomes are going to be. The more the number of bets you take, the more predictable the outcomes are going to be. Now, the logical question before I end is that, sir, but अगर इतने bet लेंगे तो हमको फिर वो concentrated portfolio वाला the big debate that happens all the time. उसका बहुत simple सा answer है that when you have 100 bets, you will find again statistically that after 2 quarters, 4 quarters, even 6 quarters, a few of them are outsized winners. Beach में there will be an average bunch and then there will be the bad ones, the 20-30%ers. You will exit them out, rotate back into your winners. That's how the concentration will happen. The concentration cannot be an input. It has to be an output of your portfolio strategy. So today, in fact, on the car ride here, there's a trade I'm going to be doing Monday, Tuesday or some day. That will make that particular thing become a very large part, not a very large, but decently large part of my portfolio. Okay, but that's because I have bought it, kept buying it, rotating out of the losers into that and a bunch of others. So it is coming out of a process of eliminating the losers, backing the winners in your portfolio. But I've started out with a very wide catchment. Only then this probability will work for you and only then you should end up with concentration. But don't start out thinking कि 5 stock लेंगे उसमें से मुझे वो तो then it's a sure shot way for bankruptcy, boss. I can tell you this much. And plus the emotional high low of 5 stock, 10 stock का portfolio है, you will first of all not be able to sleep because your portfolio is so dependent, exposed to a bunch of stocks which is very narrow. So cast your net wide, build your 12,000 paintings, your hundreds of plays. Tom Hanks की पढ़ रहा था मैं. He said, I've made so many crap movies. You remember Forrest Gump and a bunch of others. But I mean, if you look at the portfolios of movies, बहुत फालतू भी बने हैं. But बनाना पड़ेगा ना, तभी तो एक मिलेगा बीच में. So when these are dadas of their own businesses, they have done hundreds of bets, then why are you going to do 10 stocks? You have to do 100 stocks to get to your 5, 10 outsized winners. That's pretty much what my learning is, and I'm happy to share that with you.
We'll take 1 or 2 questions from the audience.
Hello, sir. I am Ashwini. Sir, I have a question. With going global turmoil, which is the one macro indicator that Indian investors should look upon, and one more adding to it, for budding professionals like us, what is the key differentiator or key skill that we should focus on to become a differentiator between a good market analyst and a great market analyst?
So I'll answer the second. One indicator ऐसा कुछ है नहीं, boss. I mean, if you're wanting again a very simplified answer to a very complicated world, there are many indicators. But the answer to your first question is, I cannot tell you what has worked for me. Okay, everybody has different perspectives, different ways of doing it. You will have to enter this game. Over 5, 10 years, you will find your own indicators. You will create your own indicators if you're truly bright, and you will find that that works for you. Like, for example, today, given the amount of demands on my time of holidays, not of work, I have no time for itna indicator nahi dekhne ka. It's simplified after 25, 30 years. I just watch a few things. I spend 5, 10 minutes a month. And that's good enough to make a decent living on a global macro basis. You will create your own. So don't ask that answer from me. You have to create your own answer. That is point number 1. What is your second question?
What key skills should we develop to differentiate between a good market analyst and a great market
So
analyst?
one of the big divides in the market is he's an economist, he's a technical analyst, he's a fundamental analyst. You have to be an all-weather player, being able to understand all the moving parts. To don't just distinguish between each of these disciplines. They're all going to combine together to make you a better investor. So you have to understand each, not to the best of that particular discipline's number one guy, but a good enough level of knowledge of technicals, good enough knowledge of fundamentals, and a decent level knowledge of macro. If you combine all disciplines, you will increase your probability of success. But if you say कि मैं fundamental का आदमी हूँ, मैं technical नहीं देखता, मैं technical में chartist हूँ, मैं ये नहीं देखता, वो तो economist हो, वो देखता है, you are not going to be a consummate player of all weather, bull market, bear market. Then you are really just saying कि मैं तो सिर्फ off side का player हूँ, मैं leg side का shot ही नहीं खेलता हूँ. Then you're never going to play in a game in which the bowler has figured out your weakness, and then they would bowl on the leg stump and you will get out at some point.
Yes.
Myself, Misa Mehta, and so my question is, like, during while allocating capital, should I repeat myself?
Yeah, please. Sorry, I was looking at you.
So my question was, by allocating capital, what should we look at? Like, how do we mentally separate the structural change from the cyclical disruptions?
Now, that is a very complicated question. Again, I mean, you know, it's hard to give one-line answers to these questions. बहुत हमको 40 साल लग गया, अभी तो समझ में नहीं आता. So, you know, I just think you have to get into the game. You know, this is the classroom. Get out there, start putting capital to risk. Keep a wider catchment. A lot of answers will come organically. Okay, your professors are very good, but remember, professors are professors. Practitioners are practitioners. I know you have a program in which you have practitioners coming over. The only advice a good practitioner should give you is go out there and start batting in the game. Net practice is up to a point useful, but match conditions in front of the crowd, that is where you're going to be tested. So test yourself. As I said in the beginning, create stressors in your life. When you create stressors, you will adapt and become better. But there is no easy answer to your question that how should I segregate between structural and cyclical and all that. I don't know. We'll see.
Thank you.
Yeah.
Due to paucity of time, we'll stop there with the question and answers. Great insightful session. I'm sure all of us have had some learnings. We started with the 1990s economic shift, which was quite instrumental in shaping Sir's outlook at investing. Then there are stressors which we need to identify. We need to push ourselves, and that is how we'll grow to learn and make new things for us. Identifying our opportunities, that is a key takeaway. So
Expanding your opportunity set,
Yes.
that is critical.
So the scenario will keep changing. It is up to us. We need to have an eagle-eye view for the market. We can't, segment our skills and look at specific things. We need to take things as a whole. But when we are investing, when we're throwing our hands out, we need to push for the galaxy, and then we'll end up catching a few stars on our way at that stretch. Thank you, sir. This was a great, great session. I'm sure the audience benefited, all of us, many learnings from this session. We'll now move on to the felicitation. As we draw a close, we'd like to thank and present a token of appreciation to our esteemed panelists. I'd like to request Swati Godbole ma'am to kindly felicitate Mr. Shankar Sharma. I would like to request Dr. Rashmi to felicitate Dr. Hitesh sir.
Thank you very much, Hitesh, for moderating. It was nice. And
thank you, ma'am.
Very nice to hear you. Thank you.
Thank you.
I request Dr. Rashmi to kindly present the vote of thanks for this session.
Good afternoon, everyone. So as we come to the conclusion of the Investrix, it's my privilege to be present here the vote of thanks to, on behalf of KG Somaiya Institute of Management, Center of Excellence in Capital Market, and yes, of course, the Fin Street Committee and the team. So thanks to all the speakers. Anyways, they are in rush to go. So I should, skip all those things. Thanks to all the speakers. Those, he is still here. Thank you so much to hearing me for this. Tushar. Thank you, Tushar, for taking time and coming here and sharing your expertise. And it was a great listening to all the panelists, all the speakers. And I hope our students also got a good learning and a lot of, foresight to understand what they need to do once they come out from the college and go into their industry. So thanks to all these speakers, thanks to our moderator. And yes, as Warren Buffett said that, the risk comes from not knowing what you are doing. So obviously you need to today, after hearing all the conversations today what we have, you need to meaningfully reduce the gap by blending your academic thinking, what you are learning inside the class, and now looking at the market wisdom. So that's what I believe you should need to think about that. Right? So I would like to express my sincere gratitude to our director, Dr. Raman, for supporting the event and whose vision and continuous encouragement, which is making these events very successful. And my thanks to my faculty colleagues of the department, thanks to their support, then admin staff, the Rohit, Aarti, and Arvind, the IT staff, and all the support staff who are directly and indirectly associated with this team, for the seamless coordination of the program, the PR. And yes, the special thanks to all the students who have attended this program, and more special thanks to the Fin Street student team. So I would say that the Fin Street student team has shown their ownership, discipline, and professionalism, which truly reflect leadership in action. And that's what we are looking forward to look at into that. So thank you so much. And we know that whatever guidance, whatever, the learnings of the today's you have from this session, it will help you in the future. And all the best to all of you. Thank you very much and have a wonderful day ahead. Thank you.
Guys, we're taking an attendance call, so kindly stay seated.